I'm Brad Smith alongside Shauna Smith. This is Yahoo Finance's flagship show, The Morning Brief.
Stock futures sharply in the red this morning. The 10-year at the highest level, 10-year yield at the highest level that we've seen in 5 months. This coming after the U.S. economy grew at its slower pace than expected in the first quarter. The latest GDP print reviving talks of the Fed's rate cut timing, and exactly what that could potentially look like.
When will they do it? Plus, tech also moving lower. Meta disappointing on earnings and dragging the NASDAQ lower with it. The next of the Magnificent Seven to report, Microsoft and Alphabet, both after the bell today. So let's get to it with the three things that you need to know. Your roadmap for today's trading session. Yahoo Finance's Inez Ferre, Jared Blickery, and Pras Subramanian have more.
Meta's big spending plans shocking investors. Shares of the social media giant sinking following a softer Q2 sales outlook. CEO Mark Zuckerberg urged investors to be patient after Meta revealed it will spend more aggressively on investments in artificial intelligence. Meta is set to wipe out $200 billion in market cap at the open.
And the tech sector is under pressure this morning. The NASDAQ 100 down more than 1%, with about half of that decline coming from Meta. Tech investors hoping to see a turnaround for the sector with results from Microsoft and Alphabet after the markets closed today.
Outside of tech, we have results from two airlines this morning. Southwest shares falling sharply after the company posted a wider than expected loss and warned that Boeing's airplane delays will hurt growth in 2025. The company now expects to receive only 20 737 MAX planes from Boeing this year, much less than the 46 they previously thought. But shares of American Airlines are moving in the opposite direction. The company expects Q2 profit to come in better than expected ahead of a busy travel season.
Well, good morning, everyone. Today's top story. Futures are sinking after a downbeat GDP report. The 10-year Treasury yield at its highest level in 5 months. Let's take a look at some of the wider market action that this is triggering ahead of the opening cross as well here, as we've got to look at the Dow futures, and we're getting over to some of the yields here that we're tracking. The S&P 500 futures. We'll stay on the futures for right now. The S&P 500 futures right now. You're seeing that move lower by 1.2%. And the NASDAQ futures also down by about 1.5%.
Yeah, we saw this real move lower right after that GDP print was released. Again, 1.6% growth in the first quarter, well below what the street was expecting. And Brad, you just mentioned yields very quickly. And taking a closer look at some of the movement that we're seeing there, at least for futures, when you take a look at the pricing action, obviously a huge sell-off there. A lot of that tied to what we learned about prices within this print. Obviously, higher prices. Clearly a worrisome sign here for the market, for the economy. And we're seeing that reaction in Treasury yields. We're seeing a spike in yields, a drop in prices here. So something to keep an eye on. And then outside of that GDP print, that's not the only thing driving markets this morning. We're also seeing some action here when it comes to tech and that move to the downside here that we're seeing in the broader markets. A lot of that has to do with that move lower that we're seeing in Meta here this morning. And take a look at the extended action and look at that, a drop of 15% here ahead of the open. So we're seeing that huge move to the downside. And of course, the question is, what exactly this means for Alphabet and for Microsoft, which are both set to report here tonight after the bell.
Absolutely.
All right, well, driving the market action in the NASDAQ today, that disappointment from Meta. Shares are off just about 15% here in the pre-market action after the tech giant's big spending plan spooked investors. Well, Meta will likely wipe out $200 billion of its market cap at the opening bell. For a deeper dive into the company's results, we want to bring in Brad Erickson, RBC Capital Markets Internet Analyst. Brad, it's great to have you here. So when you take a look at the reaction that we're seeing in shares off just about 15% here in the pre-market, does that make sense to you given the report that we read last night?
Yeah, probably an overreaction, to be upfront about it, but nice to see you guys. Thanks for having me, by the way. I think from a revenue standpoint, things were generally fine. They beat sell-side consensus actually for Q1 and guided slightly ahead for Q2. I think the investor side, buy side, was probably closer to an inline report. The issue was obviously cost, right? They raised the operating expense guidance modestly, and then the CapEx was the big one. They raised that 12%, 8% ahead of the street. To us, that's maybe a bit more of an appropriate magnitude.
So coming off of the year of efficiency, of course, it was celebrated given the stock price reaction that we had seen out of the gate in the first quarter of this year. Now you get these results, Brad. What is this year for the company? The year of spending, the year of CapEx?
Totally fair question. As we were talking to the CFO last night on the callback, I think it's still, obviously maybe not the year of efficiency is the quite right way to say it, but they're still very, very focused on controlling headcount costs. They kind of called out that none of this increase is really owed to anything from that perspective. So I would say from that perspective, year of efficiency is still very much in play. This is a capital expenditure issue where they're having to spend a ton of money to build infrastructure and obviously acquire GPUs to run their AI research and product development in the future.
Brad, what do you see that ultimately the impact that it's going to have, the Gen AI investments here? What is that going to do to engagement here in the longer run? And what do you see it doing, the impact it's going to have on revenue for years to come?
Yeah, for sure. We think it's a kind of the next leg of outperformance type growth relative to the ad market in general. It does a few things, right? One is that it helps them develop, we call these probabilistic models. It basically means that they're figuring out what ads are driving which conversions, and then they're optimizing and making those campaigns perform better and better. Two, you mentioned it, it recommends content, right? Everyone knows about kind of the TikTok killer algorithm. Meta's worked on that a ton with Reels in the last year, and that's going to continue to get a lot better and cause people to spend more time on it. And then third is we call it kind of, it has the potential to increase users' utility of Meta. And specifically, it's things like using a virtual assistant as kind of a research tool and a discovery tool on the internet. And then also think about businesses connecting with their customers in new ways, not just customer service, but just maintaining a much more open line of communication with their customers. That's adding actual utility. That's revenue growth for these guys. So there's a lot of ways it contributes in the future.
How accurate will those engagements with an AI type of engine or interface need to be in order for businesses to feel comfortable relinquishing that? Because they've talked about how successful conversions have been to drive purchase decisions. And now we're talking about conversions with relation to making sure that you're not losing out on the digital body language or missing out on that and ultimately dampening or hindering a customer relationship.
Yep, totally. Yeah, I think if you talk to most companies or a lot of companies, executives who have begun, certainly the ones that have a customer service or support component of their business, I think a lot of them will tell you there's still very much a human component. They want to deliver the right experience that's on brand, exactly what their kind of mission as a company or product is. I don't think any of that changes. I think with that said, I think Meta's capabilities on this front can fill in and drive a lot of efficiency there. There are still going to be a lot of sort of like trivial black and white things that customers are going to really appreciate a more direct line to the company for, even without missing out on a lot of the value that I just mentioned. Digital body language was the term you used. I like that. I may steal that. I think that's still really important, of course.
Brad, when we talk about what exactly this could mean for some of the other larger players within the group, we're seeing a reaction in shares of Alphabet here this morning, amongst a long list of companies, obviously, that are taking a hit following the results here from Meta. Does this signal anything just in terms of a reality check maybe that we could be getting from Alphabet, from Microsoft after the bell here this afternoon?
Yeah. Just to be clear, I won't comment on Microsoft because I don't cover the stock. But for the other ones, certainly the advertising names. I mean, there's two read-throughs, right? One is just on the digital ads market. I would say the fact that Meta met expectations but didn't exceed, probably could be a little bit of a net negative there. Just that we know Meta is outperforming the digital ad market. With Google, there's data out there, so investors kind of have a sense of what the results are. But I think for everyone else, given that Meta's outperforming, it could lean a little bit negative on that front. And then on the capital expenditure side, right, that hits at the cloud business and the infrastructure build. It's a positive from that perspective. All these companies are spending more. The issue, of course, is Google is both a spender on that category as well as a beneficiary, and so it kind of works both ways. So it kind of is a mixed effect for Google from that perspective.
Brad, just lastly, while we have you, I mean, we're looking at about a $75 pullback on shares of Meta this morning. A lot of investors, as they're charting their strategy for not just today's trading activity, but looking out into the horizon, trying to figure out if this is a dip that they should buy in on. What within this report tells them that there is something that they can kind of hang their hat on if they choose to do so.
Yeah, I think, Mark on the call talked about how they've been through some pretty messy transitions historically, three in particular, mobile, when they shifted to stories as a new service, and then most recently when they shifted to expanded into Reels, short form video. And they've always done it really successfully, but it's always started out with a period of investment and pretty volatile downward reactions in the stock. And I think this one's no different. So the question you got to ask is, as you think about, do you want to buy the stock on this pullback or not? Do you believe that AI is going to be this transformational driver for this company? If you think that they can do a lot of the things I was talking about earlier, buy the stock. If you don't, I guess not. We'd be buying it.
Brad Erickson, RBC Capital Markets Internet Analyst. Brad, always a pleasure to grab some time with you. Thanks so much.
Thanks a lot.
Certainly. IBM shares plunging this morning, nearing their worst single-day % drop since 2021. The company missed Q1 revenue expectations and posted weak consulting sales, disappointing investors. The miss is overshadowing Big Blue's plans to acquire infrastructure cloud company HashiCorp. You're taking a look at shares down right now by about 10%, and it's kind of like a bang-bang thing here. Sure, it's on the revenue side and a miss there, but in the bang-bang play, of course, that we talk about in baseball all the time, there's also this other activity that's happening simultaneously, and that is the acquisition. And typically, you would see an acquisition, a company making the acquisition, shares move lower, investors trying to price in exactly what's the accretive nature of that deal would look like, and then at the same time, how much they're shelling out for HashiCorp, a company that just went public at the late end of, I think, the last month in 2021.
Bang, bang, sums it up right
Bang,
there. IBM's results, the news of the deal, and the stock reaction, all summed up in just 2 words. But let's talk a little bit more about why IBM is acquiring HashiCorp, because Brian Sauser, executive editor, was on the phone with IBM CFO Jim Kavanaugh earlier here today, and he was talking about why this is a tremendous, in Kavanaugh's words, it's a tremendous strategic fit here to the new IBM of a hybrid cloud and AI company. So talking about where exactly he sees the direction of IBM here going forward. They have confirmed that this is the largest deal that they have made since the deal for Red Hat, which was several years ago at this point. So again, the extended reaction here or the pre-market reaction in this stock here ahead of the opening bell when it comes to IBM, the fact that shares are off 10%, a lot of that tied to how much maybe they are paying for this deal. Not exactly a huge surprise. A lot of times you do see that company that is acquiring another one under a bit of pressure here on the heels of that news. But he also went on to say that he thinks it's a major transformational shift for IBM that's complementary and that drives the next leg of scale of Red Hat and IBM as a hybrid cloud platform. So again, talking about what exactly this is going to ultimately do here for IBM, for the business, for the bottom line in years to come as they do shift and focus more on AI and that hybrid cloud strategy going forward. At least Kavanaugh making the point that he views it, and the executive team obviously views it, as a smart move, a strategic move for IBM at this juncture.
2 words that this is about, and there's actually a hyphen in between them: open source. And that's what it comes back to at the end of the day here. IBM leaning more into their open source strategy. They talked about that on the earnings call after the earnings were released, saying that they're going to be leveraging the open source combination of AI models, whether they're IBM's or own models or open source models such as Llama from Meta, Mixtral from Mistral as well, which sounds like a rapper name, I don't know. But anyway, all they can do here is think about deploying these AI models across multiple environments, and open source is really what HashiCorp also helps out with on the open source project side with the community of users that they have. They talked about that in their S1 when they went public as well. So kind of a collaboration of the open source efforts there.
Yeah, and also a lot of the focus here, at least when it comes to the results, was ultimately on the fact that we saw unchanged sales here for at least the consulting side of the business. Overall revenue had increased just about 1%, $14.5 billion from a year ago. Free cash flow was $1.9 billion. That was actually an improvement from the levels that we saw a year ago there. But again, we're seeing some downward pressure on the stock, a lot of that likely tied to this deal.
Absolutely. Well, let's go from the cloud to the skies, even further, I guess. A tale of 2 airline results this morning. Southwest shares plunging after saying it now expects to get 20 737 MAX 8 planes from Boeing in 2024. That's down from the previous 46 that they anticipated. The airline also saying that they expect revenue to grow in the high single digits for 2024. That is lower than the previous expectations of double-digit growth. You're taking a look at shares right now. They were down pre-market here by about 8% ahead of the trade, and we're continuing to watch that very closely. I think going forward here, and it comes back to actually something that we spoke with Delta CEO Ed Bastian about, and they had a profitable quarter, Delta did, and he made this statement when I spoke with him about this most recent earnings period and what he anticipated from the rest of the airline industry. Let's play that real quick.
Well, that's the reason we were able to generate the profit in the first quarter. We expect we'll be the only, if you believe the analysts, the only airline that's profitable, only major airline that's profitable in the first quarter.
So hashtag Ed was right. And at the end of the day, I think it really comes back to a few things. Number one, it's the corporate travel, where corporate travel and the margins that continues to provide Delta versus some of the other competitors out there, where that is ultimately benefiting them. And then additionally, it is the aircraft capacity as well, and how that's impacting capacity versus where they were expecting to take delivery for some of the other major airlines we've heard from.
Yeah, and Bob Jordan in this earnings release saying that he cited significant challenges this year and next on those reduced deliveries here from Boeing. We talk about the impact that is having on United. We talked about the impact that's having on a number of the larger airlines here. Obviously, like you were just talking about, so clearly this is the latest. Southwest citing that as a huge issue and something that's going to restrict revenue here, at least for the immediate future. All right, let's take a look at another airline here that's also moving, but this time in the opposite direction. American Airlines shares on the move to the upside, climbing after the company said that it expects current quarter profit to be better than expected. You're looking at a gain of just about 2%. And Brett, even going back to what you were just saying a minute ago, when it comes to the rebound in corporate travel and business travel, American Airlines calling that out as a real bullish sign here for the quarter. Also, the expectations of a strong demand in the upcoming summer travel season, very similar to what we heard from United, very similar to what we heard from Ed Bastian in your conversation there in terms of what some of the other large domestic airlines are expecting here in terms of demand coming up over the next several months. I also highlighted some of that robust travel, not only here domestically, but also what they're seeing in terms of interest for international routes this summer. So I think this all points back to what we have been talking about, what exactly the prices are going to potentially look like here this summer. And when you've got demand, couple that with the fact that many of these airlines are restricted in terms of their flight routes, they're not able to add the number of flights or add the number of planes in the skies that they initially had planned, could lead to higher prices eventually.
Yeah, I only highlighted one thing within this American Airlines earnings report. Usually, my entire thing is like, just look at that, the whole front page highlighted. But anyway, the only thing that I highlighted for this one is really coming down to the forecast and what they're forecasting here going forward. Something that you heard across the airline space here, even as you think about what United is saying, and it really comes back to what you were mentioning a moment ago, that demand for this current quarter expected to remain high, expected to remain elevated. And then additionally here talking about where they're expecting the best operational results in revenue for that quarter. And so we'll see exactly how they're able to deliver upon that at a time where they're going to be navigating some of the broader kind of aircraft and fleet that they do have. I think the fleet is something to pay attention to as we go on throughout the rest of this year. This means more maintenance if they're unable to take more aircraft. You've got more circulation of those. You might even have to see some leasing also enter into the expense mix equation as well.
All right, well, we have so much to get to here. This is just a taste of what is up ahead for the next hour. We've got more on the earnings front coming up on the morning brief. First, just how much are people willing to pay for burritos? Well, more than you might think. Chipotle shrugging off higher prices in its first quarter and delivering a huge earnings beat. We are going to speak with the company's CFO, Jack Hartung, later this hour. And coming up, the theme of the day is AI. Shares of ServiceNow sliding despite a beat in the first quarter. The company touting new AI tools in its report. ServiceNow CFO Gina Massanuno is going to join us in just a bit. Plus, shares of Microsoft-backed Rubrik will begin trading on the New York Stock Exchange today. Our executive editor, Brian Sazi, is going to speak with their CEO on the Closing Bell Show. Market domination. You won't want to miss that. Keep it right here on the Morning Brief.
This morning's GDP report showed the U.S. economy growing by 1.6%. That's well weaker than the 2.5% that was expected. But with consumer spending remaining strong, what does that mean for inflationary pressures and potential rate cuts? Joining us now to discuss, former Reserve Board economist Claudia Sahm. Claudia, great to have you here on the program with us. Maybe I'm just flabbergasted trying to figure out what this print means for the Fed and how it changes the tenor of their conversation at the next meeting, if at all.
The Fed's going to look at data big picture, right? So one number, particularly thinking about, it was a surprise on what the markets thought, that is not, enough to really move their thinking. And in particular, and you mentioned this, consumer spending looks really good under the hood. Business fixed investment, so set aside those inventories, the investment business making are really good considering interest rates are a lot higher. And so that's what we think of as kind of the underlying pace. Where do we think GDP is headed? Today we got hit by imports had a bigger drag. That's a very noisy series. Inventories were a little into play. These are not things that should change our view on the economy. It's been strong. It continues. The underlying pace continues to be strong. That's not bad for the Fed. Right? We had a strong pace last year. Inflation came down. Frankly, the Fed thinks it can lean on a strong economy a little bit, get it some time to get comfortable with inflation.
Claudia, when you take a look at this number, when you take a look at the fact that maybe PC is going to surprise here to the upside if we do see any sort of elevated print here tomorrow before the bell from PCE, what does it signal just in terms of what the Fed is then likely to do? How far out could we potentially be pushing that first rate cut?
Everyone said, and absolutely the Fed, Jay Powell, when he's been out talking towards the end of last year, there had been some real progress last year, but it was going to be a bumpy ride. Well, we got our bumpy ride in the first quarter, and the progress really slowed. There has been progress. It's just been really slow. The target index for them, the personal consumption expenditure index, has looked a little better, but still it's slow. They want to build confidence. Confidence takes time. So we are pushing out, I think, where the Fed probably will start their cutting, and yet we are set up for them to cut this year, and probably more than once. But you know what? They're going to be driven by the data, and there's a lot of data we don't have yet.
Yeah, and Claudia, that's a good point. And I want to bring up the move that we're seeing, the action that we're seeing in the yield market today, because that bump higher in yields obviously tied to that pricing data that we're getting in this GDP print. But you say that it is likely that the Fed is still going to cut before the end of the year. What do you think then what does the Fed need to see in order to be confident to make that first cut? And when we talk about the improvement, I would guess that you're expecting then to see on the inflation front, where do you see inflation then trending between now and year end?
There is a very clear path. Given what we know now, there is a clear path for inflation to slow. And in all likelihood, we're going to see a pickup in that disinflation. Maybe not as much as last year, but we're going to get moving. The Fed's target price index is within a percentage point, less than a percentage point of the 2% target. And they have told us over and over again, and it is good practice, they will not wait until 2% to cut. So we got to see more progress to 2%. Things can't stall out. And goodness, they cannot inflation pick up. Again, the Fed's going to be driven by what it sees happening in the world. And yet we know things like the shelter prices, the owner's equivalent rent. We got more data on the rent people are, like the contracts they're signing now, have really come down. So it's in train. We see it, but we have gotten surprised. And there could be other surprises down the road. So I understand why markets are having a hard time getting a read on the data. And yet we should remember that the Fed doesn't wake up, look at one release and go, wow, we have to totally change our thinking.
Where do you think the data, especially on that housing front, needs to continue to trend towards in order for the Fed to feel confident with its cut decision when they do make that?
The Fed is looking for things back to normal, which doesn't mean it has to look exactly like before the pandemic, say in terms of inflation. But if you look at the pieces of the quote unquote excess inflation, so like what pieces of spending are running above the inflation before the pandemic, the leader is the shelter, particularly the owner's equivalent rent. We have every reason to believe we're pointed in the right direction of that slowing. Do we know how much or how fast? No. I mean, it's coming much slower than what we had expected. the other piece, I mean, there are some other pieces of services, and some of it's pretty eclectic and echoes of COVID. I mean, the consumer price index, motor vehicle insurance is another big excess. That isn't as much in the PCE, but it just shows we have far fewer enemies in the fight on inflation than we.
Claudia Sam, we really appreciate your insight, especially on a day like today. Thanks so much for hopping on early with us here on Yahoo Finance. Claudia Sam, Sam Consulting founder.
Thank you.
Well, we are just minutes away from the opening bell on Wall Street. We're going to take a look at some of the biggest movers that we are seeing here in pre-market action. Again, a huge sell-off that's going on across the board when it comes to the major averages. That's tied to that weaker than expected GDP print. Also within that print, we saw a spike here in pricing. So exactly what that means for equities, we're going to break it all down when we come back.
Ten seconds away from the opening cross here this morning. Yes, it is Friday's Eve, Thursday, and let's get this quick check of the market sponsored by Tasty Trade. As of right now, you're seeing the opening cross play out at the NYSE and the NASDAQ at the same time that we're tracking U.S. major averages poised to begin the day down here. So let's see exactly where things open up. As of right now, it's looking like the Dow opens lower by, and I'm squinting to see what that number is, 1.4%. Here is the initial read that we get at the opening cross. The S&P 500, that down by about 1.3%. And the NASDAQ on your screen there, calibrating right now. That was down pre-market. The futures pointing lower. And indeed, as we get that first official trade here, down 2% right now to start the day.
Yeah, Brad, when you take a look at the losses here, a lot of that really accelerating. Obviously, we saw tech under pressure early in the pre-market. That was on the heels of Meta's disappointing report that we got after the bell last night. And then we saw those losses start to accelerate here. We saw a deceleration to the downside as after we got that GDP print that showed growth was much weaker than the street had anticipated. Also, the fact that pricing is surging here in the first quarter, at least relative to expectations and also relative to what we saw in the prior quarter. So we saw the spike in yields. But let's take a look at a lot of the action that we're seeing on an intraday basis when it comes to those larger tech names, because we are seeing a tremendous amount of selling action. You don't have to look any further than the losses that we're seeing seeing in Meta here at the open, off nearly 15%. And that is dragging a lot of those larger cap tech names with it. We're getting Google. We are getting Microsoft after the bell here today. You're looking at 4% loss here for Alphabet at the open. You're looking at a nearly 4% loss here for Microsoft. And that's not all. You've got a name like Amazon also under a tremendous amount of pressure. So we're seeing the street take a look at Meta's results so far and asking themselves whether or not this is almost a reality check to some of the other tech names that we are going to be hearing from over the coming days, and exactly what that could ultimately do to the market's momentum here, whether or not it's going to put maybe some pressure on the larger market space here going forward.
Absolutely. Well, let's talk about that larger market space here too. Yahoo Finance reporter Jared Blickery taking a look at what's trending on Yahoo Finance's trending ticker page. Jared, tell us you got some green for us, man.
You know, I might have a little green. I was checking Altria before the market, but unfortunately, their report is being called uninspiring by Citi, and maybe we can get that quote behind me. But here's Citi, which rates the stock a neutral. We do not expect much change to consensus EPS estimates, and there it's up 1%. That is some green. We do not expect much change to consensus EPS estimates, and with no catalyst coming out of the print, we expect the shares to be flat after this uninspiring report. Now, here's Jefferies with a buy, saying it is hard to get excited about much in these numbers today. And now, if we can move on to Caterpillar, I'm afraid we got some red there. That's going to be down about 6 to 8% as it was. There you go, about 6-7% as it was in the pre-market. And this is joining Meta in just kind of leading the market down. Industrials, Caterpillar is the biggest company in that group, and there are concerns that they're showing weakness outside of America, North America. Also, they forecast second quarter sales to be lower than a year earlier. And finally, I got to hit Southwest Airlines. This is another negative print here. It looks like that's down almost 10%. That would be the worst in about a couple months here. I think you have to go back to March to see something. But they reported an adjusted loss per share for the first quarter of 36 cents. That was wider than consensus. Citi rates it with a neutral, but they had concerns as well. So lots of, I would say, more earnings disappointments than good news here before the, I guess, 5-minute mark in the open.
All right, Jared, thanks so much for breaking that down for us. Again, lots of red across the screen today. We're also going to talk a little bit more about that GDP print coming in much weaker than expected, 1.6%, making the Fed's path to rate cuts a bit more murky potentially here. Now, this report sending major indices down, and we're also seeing a spike in yields, a lot of that being attributed to the rise that we saw in prices within this GDP print. So here to break it all down and what exactly this means for the market, we've got Ryan Dietrich, Carson Group's chief market strategist here with us. Ryan, it's great to see you. So we're looking at weaker underlying growth when you take a look at this GDP print. We're also looking at higher prices. So what exactly does this signal maybe to the possibility that we could see more downward pressure on the broader markets here, at least in the short term?
Yeah, let's start with the markets. And thanks for having me back. Good morning, everyone. You know, let's not forget, we were just up 30% the past year on a total return basis for the S&P 500, up 27% 100 trading days off that late October low. And when you look at some, Jared, thank you, Jared. He actually shared one of my charts in your morning, the daily briefing email that went out. When you have a big start to a year, an election year, you tend to have some indigestion right now. Your average election year from now until about Memorial Day, maybe even a little bit early June, tends to be a little weak. So after that rally, we think this is kind of normal. Now, to get to the GDP, I love the conversations I have with Claudia, because again, yes, the headline looks weak, 1.6%. That we were about to have 7 in a row above 2%. We missed that, obviously, unless it gets revised higher. We'll have to wait and see on that. But if you take out inventories and exports, actually GDP was 2.8%. If you take out government spending, which is a little bit weaker, is 3.1%. What's that tell us? Well, final demand is still really strong. So we can get into the inflation part of it next. But overall, we're not too overly concerned. The economy is just slowing down, because it sure doesn't look that way when you kind of break it down a little bit more.
So if we do get a revision, and I guess that's what the markets are trying to figure out, should we be banking on a revision, or should we just be taking this as it is on headline and then moving forward with thinking about whether or not the Fed, because in a bad news is good news, then that would say, hey, this bad GDP print should actually see the markets moving higher because of the prospect for a potential cut here. That's not what we're seeing, though.
No, you're right, Brad. I think we just move forward, right? I mean, we can slice and dice this all we want. We know the market's a forward-looking mechanism. I mean, again, why are futures down? Well, we know, right? Caterpillar, Jared just talked about, obviously Meta. And then if you peel back the onion a little bit, you've got higher prices. Now, that's monthly PCE. Quarterly PCE. Tomorrow, we do get the monthly PCE. Maybe it's giving us a clue. Maybe it's not. I mean, similar to what Claudia said before I came on, we're optimistic. We're trending the right way, right? We've got low unit labor costs. We've got higher productivity. Wages are strong, but also coming back. So yes, inflation is not perfect. It is a bumpy ride. We're still optimistic, though, guys, that we could have, potentially 2, maybe even 3 cuts still this year. I know we need better inflation data, but who knows? It might start tomorrow. So let's not get too overly, too overly worried here after this one data print.
3 cuts, not many on the street are still saying that at this point. Right. But Ryan, while we have you, let's talk about earnings, because we've got Meta really moving the markets here this morning. We're seeing this sell-off here in tech. When you take a look at Meta's results, does this signal any worrisome signs here for what we could see for the rest of big tech this earnings season?
Yeah, they're one of the first big ones, and obviously it's not so good. I guess Tesla, but they're not really tech, are they, I guess? But I mean, you think about it, I mean, what'd they say? Well, things were strong. They made money. Revenue is strong. It's all because they're going to continue to spend, and they shocked the street how much they're spending. So, that's a little one-off. We'll see. I mean, it's hard to just say one company matters for everybody, obviously. And in big picture, and I know Caterpillar is lower, right? But this year, we came into this year more neutral tech. After the rally it had, we said, that's pricey. What's pricey in the market? Well, the big cap tech, we're pricey. So we're more neutral as areas. We think industrials and financials. We added some industrial and financials in the models we run for our Carson partners just a few weeks ago. And again, I know Caterpillar's week, what they had to say, but there's still some positives out there, in our opinion, on the global economic front that suggest that the cyclicals will probably do a little bit better. I'm not saying money flows out of tech into cyclicals, maybe a little bit. We just think those areas are going to hold up better the rest of this year.
I'm sure Tesla would take issue with you calling them not a tech company. And
well, they're in consumer discretionary. I meant that. They're in consumer discretionary. Don't yell at me, Elon. You're right.
Yeah, I know. It's Elon that would say, well, hold up. We're a computer on wheels, and we've got junk in the front.
Good point.
All right. Thanks so much. Ryan Dietrich, who is the Carson Group Chief Market Strategist. Thanks so much for taking the time here on the day.
Thank you.
Absolutely. Ford paring back its gains after its commercial Ford Pro business saw revenue jump 36% from a year ago, offsetting the $1.3 billion loss that it saw from its EV unit. Yahoo Finance's Pras Subramanian joins us now with the details here. Pras, you have just been clamoring, waiting to talk about this with us. You've been on set for like 3 blocks at this juncture. Tell us about Ford.
Mentally preparing myself. Brian Sazi's here also. This is a big all-star crew here. But yeah, strong earnings. That's the kind of big picture. EV still a drag. Revenue up 3% to nearly $43 billion. That really surprised the street. But Ford Pro, like you said, really the star here. $18 billion in revenue, $3 billion in EBIT. Basically, they're overcompensating for that loss in EVs. And Ford, actually, their outlook, they boosted some of their outlook metrics, but they only said that their profit outlook would be the high end of its range of $10 to $12 billion. Part of that is the EV business that Jim Farley called a drag on the call last night. But then also a slower than expected rollout of the F-150. The brand new F-150 was sort of collecting on lots of dealer lots. They couldn't ship it for various reasons. So finally that's coming out, but that's going to affect their profitability for this year.
How long is that expected? Is it just till the end of the year? And when you talk about that slow revamp, because Jim Farley did call that out on the earnings call, the slower ramp, I should say, for the all-new Ford F-150, when is that going to have a more material impact here on revenue in the future?
They said they're already shipping to dealers. They're seeing high uptake from customers. So they'll catch up, but not as much as they thought they would before the year started. So it's going to be a little bit of a drag. Maybe they'll up it. Maybe they'll see strong results and they'll up it after Q2, but we'll see.
All right, Pras, thanks so much for breaking that down for us. Again, Ford shares on the move here following results. Well, Microsoft-backed Rubrik is gearing up to make its public debut on the New York Stock Exchange. You just saw them a few moments ago, ringing the opening bell for the trading day today. Now, the data management software company pricing its shares at $32 a share. That was above the initial expected range, under the ticker RBRK. Here to break it all down, what investors need to know ahead of the latest big tech IPO, Yahoo Finance's executive editor, Brian Sazi. Saz, what should we expect?
Well, this is a very simple one to explain. They sell cybersecurity that protects big data. What else do you guys need? No, really. I mean, it's
perfect. We got a jam-packed show. That's all we need to know.
This is another one of those AI plays. Of course, it's a different company than Reddit, which came public, got a great reception a couple weeks ago. This is a tough day for Rubrik to come to market. Also a tough company to understand. Full disclosure, I read this prospectus numerous times. I do think I know what they do now, which is good, but I think that is the bigger point here with Rubrik and a lot of plays that will come to market like this probably later this year. they have a lot of, I think, work to do with Wall Street to get people to understand what they do, why it's important, the size of the market, and then ultimately how they will make money. Rubrik points out in its prospectus they've never made money since their inception in 2014. They lost a couple $100 million for the 12 months ended January 31st. 2024. So a lot to prove inside of a growing market. Of course, as we explode into the AI decade, there's going to be a big importance of protecting this new technology, and cybersecurity companies like a Rubrik, like a Cloudflare, those are the companies that should ultimately capitalize. But really, a big part of the story is, in fact, the co-founder and CEO, Bipul Sinha, who I'll be talking later today down at the New York Stock Exchange with. He has just a phenomenal story. Longtime venture capitalist, really points out in his prospectus that he came from poverty in India, and he came over here and just made it happen. He essentially founded Rubrik out of coffee shops next to the offices of Google and YouTube in 2014. So he's got a great success story. A lot of investors I talked to in the lead up to this, one in particular that is an early investor in Rubrik, you're backing someone like this and the team that he has been able to build since 2014. So yes, tough business to understand, not a tough story to understand in the CEO who's just really, truly made it happen, and congrats to him.
Yeah, absolutely. He says maximal thinking is how he lifted himself out of poverty, built a life in America, and created Rubrik with his co-founders.
This guy's the real deal.
Yeah.
He's the real deal.
All right, looking forward to that conversation. Brian, thanks so much for joining us. Brian's going to stick around, actually, because we've got much more after this break. Plus, let's do a market check here, quick check of the markets as we're taking a look at the Dow, the S&P 500, and the NASDAQ, all down across the board. The NASDAQ, the biggest decliner on a percentage basis by about 2% right now. We'll be right back.
Chipotle posting strong results for the first quarter. The burrito chain's same-store sales jumping 7% from a year ago. Foot traffic climbing over 5%. We're looking at gains in the stock of just around 4.5%. The quarter also getting positive feedback from the street. Oppenheimer, Piper Sandler, Barclays, just some of the analysts here raising their price targets on the stock on the heels of these results. We want to bring in Jack Hartung, Chipotle's CFO, joining us now alongside Yahoo Finance's executive editor, Brian Zazi. Great to speak with both of you. Jack, let's talk about this once again. Very strong quarter here for Chipotle. I'm curious, what do you attribute this strength to, and what are your results, do you think, really tell us about the state of the consumer right now?
Yeah, I mean, first of all, our core business is really strong right now, and I have to hand it to our field teams, our restaurant managers, our crews. They've done a fantastic job of making sure our restaurants are fully staffed. They've hired and trained terrific employees. Our turnover is at historic lows, and our teams are executing throughput at the highest levels we've seen in a very, very, very long time. And when we execute great throughput, our customers love the idea they can come into Chipotle. They'll be served fast. They can customize their meal. It's very, very affordable, and it's the kind of food that they really want to eat. But it all comes down to execution. I think in terms of the customer, when we look at our customer base, our customers are very healthy. When we look at our income cohorts from low, medium, and high, they're spending at the same level. They're increasing their purchase, their visits, and their purchase habits when they come to Chipotle at the same level for the low income as they do at the high. I know there's other patterns out there, but so far I think because Chipotle is affordable, I think our customers are still able to enjoy the meal that they love at Chipotle.
Jack, it's Brian here. Good to see you. So look, the market's tanking today. I mean, it's a bad day for the markets, really, because GDP is slowing down and suggests the economy might be entering some type of soft patch. Are you concerned that the pace of growth that you saw in the first quarter and looks like it continued into April, that slows in coming quarters?
Yeah, we're going to watch the health of our consumer very, very closely. So far, so good. There's not much we can do if there's going to be a macro event, meaning consumer confidence and consumer spending declines. One thing, Brian, that we've seen in the past, when consumers are under pressure, if we're executing at a high level, customers tend to keep Chipotle in their budget longer than they will keep other dining experiences and other things that they want to do. They will keep the Chipotle in their budget for a longer period of time. We like the underlying trends that we saw in the first quarter. They've continued into April so far. And we're just going to keep motoring. And, our view is if we keep executing at a high level, customers will keep visiting.
Jack, regarding the California wage increases, now $20 an hour, you took price increases. That came at a time where the economy was doing good, but like we're talking about here, the economy might be slowing down. How big a pickle would a Chipotle be in, but also the restaurant industry at large? So you have these high structural wages in the key market of California, and the economy is slowing down, and then maybe you can't push through more price increases.
Yeah, from a macro standpoint in California, this is going to put another layer of inflation on top of inflation that's been really there for the last 2 or 3 years. We know that generally consumers are getting inflation wary, and so we're going to watch that very, very closely. One advantage we have, Brian, is that our prices in California have frankly lagged the rest of the country, considering California is a high cost of doing business, but our prices in California before this last action was similar to what the average price throughout the country would be. So we have a value and pricing advantage going into this. We did have to take a 6 to 7% increase. So far, we've not seen any resistance, but there could be this kind of macro across the state impacting consumer confidence and consumer spending. It is another layer of inflation on top of inflation that people are, frankly, they're ready to move on from it.
Jack, earlier when we were talking about Chipotle's earnings before you came on, Sean had mentioned clearly people are just willing to pay whatever for these burritos. And it felt a little bit like a personal attack because it's me. I keep buying into this experience. And I think a lot of consumers are also looking for what that next big menu innovation that drives demand is going to be from Chipotle. What is that? What's on the docket?
Yeah, so we're still in this cadence, and we like this cadence of having 1 to 2 limited time offerings during the year. We're still running chicken al pastor right now. Our customers love chicken al pastor. And so as soon as we announced that we were bringing it back, customers came in right away. It was a great response. That will sunset probably sometime in the third quarter. We haven't announced what we're going to do in the fourth quarter, but we're going to come up with something to keep our customers excited about what our chefs are cooking in the kitchen.
Jack, when it comes to AI, new automation, the implementation of those plans, how is that going, and how do you see that ultimately impacting Chipotle's bottom line here in the next couple of quarters?
Yeah, it's early days. We're starting to experiment with gathering customer data, gathering what are the visit habits, what are the buying habits when they do visit, and using AI to help us understand when customers' habits are changing, is there some action we can take? Like if somebody is starting to visit less, or if they're starting to spend less when they come. If that happens, what can we do in terms of making an offer that is relevant to that customer? We're very, very early days. I think we're very excited about where AI can go, but we're going to take this a step at a time. We're not going to get ahead of ourselves on this one.
Jack, what's the water cooler talk inside of Chipotle headquarters when you see a journal story a couple of days ago saying that your results are being driven by muscle-building power lifters? I mean, I'm not a power lifter. I'm in the gym all the time. I usually do go to Chipotle after I work out. I mean, I'm okay with it. I already pumped iron and burned 1,000 calories.
That's awesome. I think you should have 2 burritos today.
That's
listen,
his usual order, Jack.
It actually is my usual order.
We love that. Listen, I don't know that we've used the same language that was used in that article, but we love the idea that people who are fit, people who are athletic, and people that really seriously take care of their body, Chipotle is their go-to place. They know they can get the right amount of protein, the right amount of carbs. They can get exactly the diet. We get contacted all the time by, not just amateur athletes, but professional athletes and, college Division I athletes that they love Chipotle because it fits in with their workout routine. And we think that's fantastic.
Yeah, I'm trying my best, Jack, just to keep up with Sazi. But anyway, just lastly, while we have you here, we're thinking about next week and the trove of employment situation data that's going to be coming out, and the workplace is really being redefined. I'm wondering, how's Chippy doing, especially knowing the type of productivity that you expect to see from investments like that?
Yeah, so Chippy is still in our lab, and we've got some challenges with Chippy. Frankly, we've got a couple other innovations that we think are likely to move into our restaurant sooner than Chippy. One is the avocado, and that would cut core and peel avocados. That's a very time-consuming task that our restaurant teams do. We make our guacamole fresh every single morning. Our teams right now are making guacamole in our 3,400 restaurants. So that's a task that we do think that we can make easier and more pleasant for our teams. And the other one is Hyphen, which is an automated digital make line. About 38% of our business is on that digital make line. And this will automate at least the making of the bowls. It won't roll the burritos. That's another thing. That business really tends to come in concentrated periods as well. And so that would also relieve kind of a choke point in a restaurant. Those are 2 things that we expect will go into at least one restaurant this year. We'll see how it works in a real restaurant. It's doing great in the lab so far, but the next step would be to get it in the restaurant and have our crews really interact with it when they're serving customers.
All right, we're getting the group order fired up. Jack Hartung.
Decline push-ups here. There we go. I'm ready to go. Let's go.
Jack Hartung, who is the Chipotle CFO, alongside Yahoo Finance's executive editor, Brian Sazi. Thanks so much.
Thank you, guys.
Coming up, everyone, this morning's GDP report continues to show signs of an economic boom somewhat here. What could it mean for inflation? Of course, you've got to back out a few things in order to still see that boom. We'll speak with an expert on the other side.
Let's take a look at the sell-off that's happening right now on Wall Street. We are 30 minutes into the trading day, and you're looking at the Dow dropping 655 points right now. You've got the S&P also under a tremendous amount of pressure, off just about 1.5%. Taking a look at the intraday chart, you can see we are right around the lows of the session. The NASDAQ also under a tremendous amount of pressure here this morning, off just about 2%. A couple of things that are going on. One, that GDP print putting some pressure on the broader market, and that's on the heels of Meta's weaker than expected earnings results after the bell last night. That's a big reason why the NASDAQ is the worst performer of the three major averages. But let's talk about what's going on with that GDP print. And I want to take a look at what we are seeing, the action that we are seeing in yields. And you can see yields spiking higher, up 7 basis points, getting closer to that 5% level. The reason why we are seeing yields spike is because of what was in that GDP report. Not so much about that headline number, which was 1.6%. Yes, that was slower growth than what the street was expecting. But when you look inside that report and take a look at core PCE and what exactly that looked like there for the first quarter, that was running much higher than what the street had been anticipating there, reigniting some of those fears surrounding inflation, the fact that the Fed is far from getting to that 2% target that they have been talking about now for quite some time. So worries here about higher prices, that is sending yields higher. We're seeing yields spike to the highest level that we have seen in several months. All right, from cars to machinery, Caterpillar shares moving to the downside this morning after seeing sales in both of its construction and resource units fall from a year ago. The company, which is largely seen as an economic bellwether, also forecasting lower sales in the second quarter. Yahoo Finance's Ines Ray joins us now with the details on that. Ines.
Yeah, Sean, on Caterpillar's management on the earnings call just now said that it foresees a weak economy continuing in Europe and a softening economy in Asia Pacific, not including China. The maker of heavy machinery posted lighter than expected revenue, but its profit came in stronger than expected. Now, keep in mind that the company has beaten earnings in all but one quarter in the past 3 years. But sales were impacted by lower volumes. Caterpillar was able to offset that through pricing. The results, sales of $15.8 billion, flat compared to last year and short of analyst expectations, and earnings of $5.60 versus estimates for $5.13. Guidance for the second quarter came in light. Caterpillar expects sales this quarter to fall from the same period last year. And looking at the Caterpillar segments, energy and transportation, that was an important segment that saw gains, seeing tailwinds from infrastructure spending. Think of energy like gas generators, power plants as well. Now, taking a look at the stock. The stock had been trading near record highs coming into the print. Year to date, the shares were up more than 20%. So some of this may also be some profit taking, guys.
All right, Yahoo Finance's own Ines Ray. Ines, thanks so much for breaking Caterpillar down for us here this morning. We've got some more media earnings to digest today as well. Comcast adding 3 million paid subscribers on Peacock in the first quarter. It's boosted by its partnership with the NFL to exclusively stream one playoff game. Now, the company did, however, report a wider loss in broadband customers than expected. Shares reacting down by about 6% as of right now. And as I've been continuing to look through this report, just to put some number on the total customer relationships for connectivity and platforms, that decreased by about 166,000 customer relationships to 52 million. And then additionally, going on further, talking about that video revenue decreased due to a decline in the number of video customers, offset by an overall increase in the average rates. And then they say a positive impact of foreign currency, but other revenue decreased primarily due to lower residential wireline voice revenue as well that they mentioned.
Yeah, exactly. I think you can sum this up as being a mixed quarter here for Comcast. Yes, there's a lot to take issue with in this report, but revenue, though, you have to remember, was stronger than expected. And looking under the hood at some of those more worrisome parts within this report here, they did lose 55,000 residential broadband subscribers, 10,000 business broadband subscribers there for a total of 65,000. So some of that weakness really showing here within the reaction to this report. You can see shares under pressure today, off just about 5.5%. And I think the question here going forward is obviously when you take a look at these numbers, cord cutting, that momentum, picking up steam, it's on full display within this report, exactly what the company is going to be able to do to offset some of that pressure there. Yes, we did see Peacock add a substantial number of subscribers. Whether or not, though, that is enough to offset the losses that they're seeing in one of very lucrative parts of their business there historically, I think that's a big big question for investors, for analysts here going forward.
Yeah, a lot of marketing dollars have to go into getting subscribers on that. That impacted the margins. Adjusted EBITDA margin decreased to 56.7%.
Yeah, and that's something that's not only Comcast, but obviously industry headwinds here across the board. All right, coming up at the top of the hour, more fallout from Meta's latest earnings results. And later, we will be speaking with the CEO of AstraZeneca. He will join us for the latest on their earnings report.
And of course, at 11 a.m., we'll be hosting Wealth with me. Hey, Redfin CEO Glenn Kelman's going to be joining me to tell us why home costs in the U.S. are higher than ever. We'll be right back.
Welcome back to Yahoo Finance. I'm Shauna Smith alongside Brad Smith. 30 minutes into the trading day. Let's get to our biggest stories of the day. First, got to talk about that sell-off that's happening right now and taking a look at the pressure that we're seeing on the broader market. This comes on the heels of that softer than expected GDP print that we got and also faster inflation here in the first quarter. The Dow now off nearly 700 points, and you can see the S&P falling back below that critical 5,000 level.
And the Nasdaq taking a massive hit as well, with about half of that drag coming from Meta Platforms. Shares of the tech giant sinking after it disappointed investors with the second quarter revenue forecast below expectations, plus announced plans to spend billions more than investors expected, driven by artificial intelligence investments.
And investors now looking to Microsoft and Alphabet to hopefully set things back on track, although you can see pressure there across the board for those two stocks. Both tech giants reporting after the bell here today, and the eye is going to be on whether or not we're seeing any proof of the massive bets that both companies have made on AI. We want to get to some breaking news on the housing front. We've got pending home sales. Those rose 3.4% in the most recent month here. The estimate was for a growth of 0.4%, so better than expected there. And take a look at some of the trends that we're seeing on a regional basis here, Brad. You've got Northeast, that was up 2.7%. Midwest, though, actually fell 4.3% on a month-over-month basis. In the South, we saw a rise of 7%, and in the West, it was up 6.8%. So again, the Midwest being the outlier here within this report with that drop that we're seeing on a month-over-month basis.
Yeah, this report just screaming big Northeast Corridor, Amtrak energy here with those signings rising in the Northeast. One of the huge things, though, to also think about is what they're saying, and this is from a good friend of the show, NAR Chief Economist Lawrence Union, who's saying meaningful gains will only occur with declining mortgage rates and rising inventory here. However, this pending home sales index at 78.2, they mentioned as well, marks the best performance in a year, still remains a fairly narrow range over the past 12 months without a measurable breakout here as well.
And it's important to keep an eye on this because this is often viewed as a leading indicator of existing home sales. So again, maybe if we get a strong print like this, or at least stronger than expected, I should say, of a rise of 3.4%, this could potentially indicate maybe some strength or maybe a rise that we could ultimately see here in existing home sales in that next print.
Yeah, expecting to see median home prices increase by 1.8% in 2024 to a record of $396,800. I know, right? All right, we're going to continue to track that data and how it impacts the markets here on the day. We're also tracking Meta. We're seeing investors and analysts react to Meta's increased spending expectations, now seeing up to $40 billion in capital expenditures in 2024. This is coming off of Meta's year of efficiency, where the tech giant honed in on cutting costs. But now, the game has changed as every tech company races to be a leader in AI. Meta CEO Mark Zuckerberg seemed to be seeking patience from investors on the earnings call Wednesday night. This is what he had to say.
We've historically seen a lot of volatility in our stock during this phase of our product playbook, where we're investing in scaling a new product but aren't yet monetizing it. I think kind of smart investors see that the product is scaling and that there's a clear monetizable opportunity there, even before the revenue materializes.
An analyst at Hargreaves Lansdowne said about Meta spending that it can't afford to take its eye off of the core business, which is advertising. So how could this AI bet impact the company long term? Joining us now, we've got Roger McNamee, who is the Elevation Partners co-founder here. Roger, thanks so much for taking the time here with us this morning. You hear what Mark said on the call last night. What was your reaction?
Well, I'm sure Mark is right, but I think investors who are selling the stock today are more right. Meta as a stock has just had a fantastic past 12 months, and it did so in the face of rising regulatory action in Europe and legal cases in the United States that jeopardize the core of its advertising business. And I think all that's going on today is that after a big run, investors are pausing, taking a look at this thing, taking some gains, and asking some very basic questions like, how real is generative AI? And how real is mixed media glasses? Is that a real business, or is that just something that, CEOs fall in love with when stock prices are rising?
Roger, we spoke to an analyst of Meta last hour, Brad Erickson of RBC. I want to play a quick soundbite of what he had to say. He was talking about Meta's CapEx spending, exactly what the plans look like, how that fits into what he still sees as a year of efficiency. I want to play that quick soundbite and then get your reaction on the other side.
I think it's still, obviously, maybe not the year of efficiency is the quite right way to say it, but they're still very, very focused on controlling headcount costs. They kind of called out that none of this increase is really owed to anything from that perspective. So I would say from that perspective, year of efficiency is still very much in play.
So you're saying year of efficiency is still very much in play. I'm curious, so, and you're saying it's hard to grasp some of these AI plans or exactly what it's going to mean ultimately for the business, but from an investor perspective, is it in a sense making Meta relative again, given that underperformance that we had seen previously before they started announcing some of these AI initiatives?
If you believe that generative AI is real, then these investments may well work. Mm-hmm. The challenge that we have here is that this is a classic example of a product category where the demos are mind-bending, but the reality is something far less than that. And I think that we have seen consistently in use case after use case that the actual performance in the field has real issues. And the industry itself is trying to pretend like it's not a problem, that the amount of electrical power it requires is greater than the largest states in the country, that it needs more water than a small country, that the architecture itself appears to be deeply flawed, that as you increase the data geometrically, the performance of the product only increases in a linear fashion. And that's the exact opposite of what technology is supposed to do. It is entirely possible that we're going to look back in 5 years at generative AI and realize that the whole thing was a mistake. And the big tech companies have all made a giant bet on this. And the bet they're making, I think, literally could cascade into effectively a bear market for the big tech companies because they're so overcommitted to this that in Google's case, they've allowed generative AI to really undermine the quality of its search product, which is the core of Google's business. And I think at Microsoft, I have no doubt they can sell tens of billions of dollars worth of generative AI, but I have great doubt that their customers will get any value from it. And, again, I'm not saying here that generative AI is not going to work. I'm simply saying that essentially 100% of the market is betting that it is the next big thing. And that feels a lot like a mania to me, and the odds of disappointment are very, very high.
I mean, you're talking about hundreds of $billions of market cap being wiped out, potentially trillions of dollars of market cap being wiped out if it does not come to fruition. So for a company like Meta, like we've been discussing, what are the key pillars of generative AI that they need to get right in order to solidify their own positioning as they're kind of making these investments and looking across the entire kind of pillars that Mark Zuckerberg has put out there before, the applications, the models, and then one area that they don't participate on the chip side?
Well, to be clear, I'm not sure there's anything it can do. If you look at this from an architectural point of view, the inefficiency of generative AI is greater than any technology product that has ever come before it. I mean, I had always thought that crypto was the most inefficient technology product ever invented, but generative AI is much, much worse than that. And again, if you're just looking at it without listening to what the promoters say and just look at how it actually works, it's not impressive at all. The product was designed to fool people, right? To pass a Turing test. And in order to do that, they optimized it to make it persuasive. So the product itself can't distinguish between fact and fiction. And you apply that in an enterprise setting, that's actually not useful. If you apply it to search, it's not useful. No one wants to fact check their search results. And so my only point to you here is not that generative AI is going to fail, but rather that 100% of the people expect it to be the biggest thing ever. And therefore, the chances of disappointment are unbelievably high, and the chances of a catastrophe are high enough that we should be paying attention.
Roger, let's talk about TikTok here and ultimately what that means for Meta, because we got the news earlier this week. Obviously, lawmakers, the Biden administration essentially banning TikTok unless it's sold here to another company outside of China here. When it comes to that TikTok ban, you brought it up as a massive issue here for Meta in the past, TikTok being a competitor to Meta in the past. How likely, one, do you think this ban is going to be? The fact that it's actually not going to sell, ByteDance is not going to divest TikTok here in the US. And then two, ultimately, what that would then mean for Meta.
So getting rid of TikTok, if it were to happen, would be the greatest thing that could possibly happen to Meta because it would give new life to Instagram. But I just can't tell exactly how this is going to go down. The bill itself is ridiculous. The problem, if you're worried about national security and American data, the things you have to ban in order are you need to ban the use of data brokers. Data brokers selling to foreign countries is obviously a huge issue. And right now, there are no rules against it. There's talk of rules against it, but right now it's still a big deal. And anyone, China, any country, can buy tens of thousands of data points on American citizens for next to nothing. You can also take that data and then use Facebook and Google and other products to target Americans. And, as long as those two things are true, TikTok's a relatively small problem. Yet TikTok is a competitive issue for Instagram that is taking away all young people. And so if this ban does go through, that will be tremendous gift to Meta without doing a darn thing to improve our national security.
Roger McNamee, I wish we had more time. We'll have to hopefully have you back soon here on Yahoo Finance. Roger, Elevation Partners, a co-founder. Thanks so much for taking the time to join us here today.
Pleasure. Take care.
Let's get to a trending ticker here on Yahoo Finance. Shares of Merck on the move to the upside, up just about 2%. The company posted strong sales results for the quarter, driven by demand for one of its key cancer drugs, Keytruda. Yahoo Finance's Anjali Kamlani joining us now with that story, Anj.
That's right, Shauna. Yeah, Keytruda, of course, the name that is assigned to Merck, and the drug that it is known for, blockbuster, coming in with $6.9 billion in sales, up 20% previously, and up 4% versus consensus. Meanwhile, total revenue came in at about $15.8 billion for the quarter. Really good, 3% above consensus there for the company, as well as their Gardasil vaccine. That's also one of the profit drivers for the quarter, $2.2 billion, up 14% compared to the previous year. So that was in line with expectations, but all a good story for Merck this quarter.
All right, Anj, thanks so much for that. All right, stick with us here because we also have our eyes on another pharma giant that we are watching here this morning, and that's AstraZeneca. Taking a look at that stock that's on the moves on the heels of its Q1 results. You see gains just about 6%. The company beat the street's estimates. For a deeper dive on those results, we want to bring in Pascal Soriot, a CEO of AstraZeneca, and our very own Anjali Kamlani, leading the charge on that interview. On, take it away.
Thank you, Shauna. Pascal, so good to see you again, and thanks for joining us. A really good quarter for you guys, and really playing out the sort of focus of the company on core areas and getting the profits to follow that. What can you tell us about how this is playing out and what that means for the outlook for 2024?
Yeah, thanks, Anjali. It's great to see you again. We had a tremendous first quarter. Overall, our revenue grew by 19%. But the most exciting part of it is every portfolio of products grew. Oncology, 26%. Cardiovascular grew. Respiratory immunology grew. Rare disease grew by 16%. Every geography grew 19% in the US and Europe. The most remarkable was the growth in the emerging market outside of China, 40% growth. It really shows that we are bringing our medicines to lots and lots of patients around the world. Our company is really doing very, very well across the geographies and across the portfolio.
Absolutely. ADCs in particular helping to drive a profit for the quarter. So that's a really good buzzy area to be in. I'm glad you mentioned China because I know that there's a lot going on, broader picture. If we look at U.S.-China ties, we of course know the Biosecure Act is in Congress right now. And you have had ties with China. I know you have operations independent as well as partnerships, as well as a target $1 billion fund. What can you tell us about how, if this act passes and is signed into law, what kind of pressure that can put on the company?
Well, I mean, China is certainly a very important country from the point of view of having to serve 1.4 billion people, but also more importantly, recently, from the point of view of the innovation that is happening in China, especially new technologies, cell therapy, T-cell engagers, and many others. So we are very much engaged in China, and we have been for many, many years. Having said that, of course, we have considered all these geopolitical tensions, and we have established a very resilient supply chain. We have manufacturing sites in China for China and some other countries in the emerging markets in particular. And of course, we have a supply chain that is dedicated to what you might call the Western world, the US and Europe, for instance. We are right now in the process of building a cell therapy manufacturing site in Maryland. So we really have a very resilient supply chain that has shown that it can sustain a crisis, and the COVID was a good example of this.
Absolutely. Moving on to one of your drugs, Farxiga. I know that has been, of course, a focus for the U.S. as well. Engaged in negotiations with Medicare, you've already said in the past that you're pretty good with where they're coming in from. What can you tell us about the response that you're getting for the initial back and forth, for the negotiations, and how much of a delta currently exists between where you're looking to land and where the government is coming from?
Well, it's a great question. First of all, I should say Farxiga is a very important medicine for the treatment of diabetes, but also kidney disease, heart disease. And it has really made a tremendous difference to patients around the world. And also the class, the so-called SGLT2 class, has made a huge difference. In the United States, Farxiga will lose patent protection early 2026. So those pricing discussions come on the back end of the life cycle of Farxiga in the United States. I cannot really specifically comment on the discussions and negotiations that are ongoing, but certainly we will make sure that we retain the ability to serve patients, leverage those discussions to make sure that the product is more affordable and more patients can benefit from this very important medicine.
Speaking of affordability for patients, you are in the ADC space. I know there's a lot of energy around this antibody drug conjugates for cancer. And that seems to be an area also where it leads to the conversation about newer technologies and the expense that patients have to take on as a result. What can you tell us about how you're thinking about moving forward in this space and the different therapies that are coming to market and how it's going to affect the wallets of patients?
Yeah, so actually, for your viewers, a very quick explanation of what an antibody drug conjugate is. It's essentially combining an antibody with a toxin, and there are very different types of toxins, and the antibody will target the cancer cells and deliver the toxin to the cancer cell. And it's essentially aiming at replacing traditional chemotherapy, and it's much more targeted, of course, so you deliver high efficacy and better tolerability. Another type of such products is so-called radioconjugate, where you attach a radioisotope to an antibody, and essentially you can complement or replace radiotherapy and target much smaller tumors in the body that radiotherapy could not traditionally target or reach. So those are really transformative agents. And we intend to combine those with our antibody, our immuno-oncology products, especially our bispecifics. And we think we can transform the care of many, many cancers. And of course, the cost of those newer agents is higher. And suddenly we are around the world looking at solutions to make sure that patients actually can afford them. In the United States, Medicare covers those injectable products, so it's a little bit easier, but suddenly patients still have copays to cover.
Absolutely. We'll have to leave it there for this quarter. Thank you so much, Pascal Soriot, AstraZeneca CEO.
Thank you very much.
Back to you, Shauna.
All right, Anj, thanks so much. Let's take a look at the markets here. We're just about an hour into the trading day. You're still looking at losses across the board, although the NASDAQ well off its lows of the session. You actually had the Dow as the worst performer now of the three major averages, off just around 640 points. The S&P off about 1.2%. And you're looking at the NASDAQ under pressure, off about 1.4%. Coming up, we are speaking with a strategist who's going to give us the three catalysts that he sees for the markets this year. We'll also get his take on that GDP print that we got out before the bell this morning. That is the big driver in today's market action. We'll be right back. We are 60 minutes into the trading day. Let's take a look at some of the selling action that's taking place right now. This market check sponsored by Tasty Trade. You can see we've got the Dow off 648 points, and you can see we are just off the lows of the session here. So a bit of a bounce, if you want to call that, higher at least for the Dow, although it is the worst performer of the three major averages here this morning. You're taking a look at the S&P 500, also sliding here off 1.2%, but now back above that critical 5,000 level. And you've also got the Nasdaq under a tremendous amount of pressure right now, off about 1.4%. Some of that selling that we're seeing taking place in tech tied to Meta's results that we got after the bell last night. But when you take a look at that broader market sentiment right now, you also got to check in on the spike that we're seeing in yields today. You got the 2-year right around 5%. You got the 10-year up 7 basis points at 4.72. So getting closer and closer to that 5% level. A lot of that is because of what we got out from that GDP print here this morning. Inside that print showing that inflationary pressures remaining sticky. That, of course, is a concern here for the market. So we're seeing that reaction play out in the bond market, also in the equities markets today. Well, stocks selling off on worries of that slower growth and sticky inflation. The S&P 500 briefly falling below 5,000, now just above that level. The weaker GDP print coming on the heels of Meta's lackluster earnings report, which has also put some pressure on tech. You've got the Nasdaq now falling just about 1.4% on the day over the last 5 days, off just about 0.7%. We want to bring in Binky Chadha, Deutsche Bank's Chief Equity and Global Strategist. Binky, it's great to see you here. So let's talk first about that GDP print, because that is a big driver here of the markets today. Lots of questions about what exactly this could signal. We're seeing the reaction in yields play out. How are you looking at today's print?
So what I would argue is that there's actually, very little to take away from the GDP print. And I think it has, very few implications basically going forward. And if anything, I'd argue it's positive. So what do I mean? If you take the GDP print and you start thinking about, the components, the largest component, of course, is personal consumption expenditure, PCE, and that's close to 70% basically of GDP. That came in at 2.5% growth. Believe it or not, that happens to be the 10-year trend. So that's why I say there's not a whole lot to take away from the largest component. If you think about the second very important component, especially basically, at a cyclical turning point, which is what we think we are at, that's really investment spending. That's telling you about, corporate confidence, how corporates think about the future. And CapEx really, has come in basically better than most people expected. The housing part actually looks also like it's recovering. So we have consumption at its 10-year trend. We are growing at its 10-year trend. We have basically investment picking up. So, slightly better than expected, but in line with the view that we are turning up. So why do we get this bad print? It's, coming from basically primarily the two largest, noisiest components of GDP, which are basically inventories and the trade balance, because we measure them as contributions to growth. So, if you take a quick look at what the trade balance did to GDP, it took off 4.5% from the headline number. I think people forget that GDP is a very volatile number. The quarterly vol is about 1.25%. And if you're talking about trend growth of 2.5%, that's a rather large proportion of noise. So not taking away too much, I think growth, is really about consumption and investment responding basically to the outlook for consumption. And those two major components look absolutely fine.
So, Binky, is this a bit of an overreaction then when you take a look at the fact that we are seeing a bit of a sell-off here in the markets and we are seeing yield spike?
I would say it's in keeping with the market's behavior, which was impacted hugely by 2022. But I would remind that we are in 2024 now, but the market is still, very much if we have good growth or strong growth, that means higher inflation. I would disagree. I would say, yes, of course, growth matters for inflation, but the growth that we've had has not mattered for inflation. If you think about, inflation relative basically to growth, which I would measure as basically by unemployment. I mean, we've been studying for about 2 years, give or take decimal points here and there. So it's not really coming from, the main driver in the so-called Phillips curve, which actually works rather well in explaining inflation historically, we would argue, or the other big driver of inflation, which is the U.S. dollar, which is, as high as it is, basically at the top of its bands. It is all really coming from outside. And it's really about U.S. inflation, and because U.S. growth's been stronger than the rest of the world, there's a tendency to believe that basically, that inflation is coming from the very strong U.S. growth. What I would point out is that these pretty strong consensus and read and view, sort of across basically economists, the market, the ECB, that European inflation, is behaving well. It's well on its way down to the target of 2%. And the market's priced in, and the ECB's told us they're going to cut rates in June. It's important to keep in mind that Europe uses a price index called HICP. It's the harmonized index for consumer prices. Well, the HICP also exists for the United States. And if you look at the HICP for the US, it actually, got down to 2% before it did in Europe. And it's been sitting at 2% since June, July of last year. So we're in 9 months of 2% inflation. The U.S. indices, the CPI and the PCE, of course, running higher. And I would argue that the main culprit there is, owner's equivalent rent, which is an imputed price. Nobody pays it. And that's what's keeping U.S. inflation measured by our, indices that we focus on. Whereas if you looked at U.S. inflation in European terms, you would come to the opposite conclusion that, European HICP core inflation is actually catching down to U.S. inflation.
So, Binky, let's talk about then what is ahead. Given all that, given some of the trends that we have been seeing, I want to bring up a chart that we've been following very closely here at Yahoo Finance. It was initially included in Yahoo Finance's chart book a few months ago, but it's still relevant today. And it's comparing where the GDP prints or projections have been relative to consensus. And we have seen this catch-up trend play out here over the last several months. Is this something that you expect to continue here for the coming quarters or coming months?
We got a poor print today, so I expect that nobody's going to be in a hurry to raise their growth numbers. I think underlying GDP growth in the U.S. is, about 2.5%, and I think that simply because if you look at the largest component, and this is something that I mentioned earlier, if you look at the largest component, which is personal consumption expenditure, and as I pointed out, it's about 70% of U.S. GDP. It's growing steadily in a trend channel at 2.5% annual rate. It was doing that for the 5 years before the pandemic. We had, of course, the pandemic blip down. We had a recovery back into exactly the same channel. And if you started, by looking at the data and the largest component, there's actually nothing to see there. It's doing what it's been doing. And that's why I call it a 10-year trend of 2.5%. So I would argue, relative to the chart that you put up, which was this, sort of 6-quarter roll forward of imminent slowdown around the corner, there had been basically an improvement, but you can still see the gentle sort of, down move. So I would argue, the macro consensus has sort of remained cautious to pessimistic and sort of, and I expect with today's print, it will remain so. But I would argue that provides an opportunity because underlying growth does look stronger, as I mentioned.
All right, Binky Chadha, always great to get your insight. We look forward to having you back here soon. Binky Chadha, Deutsche Bank's Chief Equity and Global Strategist. Thanks so much.
Thank you.
Coming up, ServiceNow is out with their latest earnings print. How is the software company's push into AI working here, benefiting here? The bottom line, we're going to talk all about that when we come back. Vouchering software company ServiceNow out with its latest earnings report. The company has been integrating generative AI technology into its software, adding to some excitement surrounding that investor story. But customers, though, might be being a bit cautious as companies look to continue to cut costs here amid this uncertain macroeconomic environment. So here to discuss the latest results, we want to bring in ServiceNow CFO Gina Mastantuono. Gina, it's great to see you again. Thanks so much for taking the time to join us this morning.
Thanks, Sean. It's great to be here again. Nice to see you as well.
So let's talk about this most recent report, because when you take a look at the top and bottom line numbers, you beat the street's expectations on both. Yet it looks like investors are focusing on the guidance that you issued there, the overall guidance just falling just short of the street's expectations. Talk to us just about some of the trends that you're seeing within your business and whether or not you're seeing a pullback here on company spending.
Yeah, we're really excited. We're off to a strong start with an outstanding Q1 performance. As you said, we beat both the top line and the bottom line, and in fact raised our full year guidance, which at a rate that's higher than we usually do so early in the year. And so subscription revenues of 24.5%. Operating margins at 30%, free cash flow margins at 47%. So we're really excited that we're out of the gate really strong in Q1. We saw significant large deal acceleration as well. So from a demand perspective, really strong. Our deals greater than 5 million up 100%. Deals greater than 10 million up 300%. So again, really strong start to the year and raising that top line guide for the full year by more than our beat in Q1. So again, really proud of what the team has executed against so far.
Gina, I'm curious what your message is to investors here on a day when there's a lot to celebrate. We ran through a number of the beats, a number of the positive trends that you're seeing within your business. I know you're not focused on individual moves like the one that we are seeing today, but I'm curious what your message is to the street on a day like today when your stock is still off 6%.
Yeah, the message is strong execution. You know, we're seeing global expansion in our most important geographies. Japan, which is an investment area for us, landed its largest deal ever in the quarter. We have incredible customers such as Ulta Beauty, the governments of Italy and Australia, Suzuki, ANA Systems. From an industry perspective, tech, media, and telecom grew more than 100% year over year. Education grew 50%. And so I'm really trying to focus our investors on the execution and the innovation that continues to come out of ServiceNow.
Gina, give us a better idea of some of that demand that you're seeing for the higher price tier that you launched the platform that includes generative AI. What do those numbers look like, and what do you expect that growth to continue to look like in the coming quarters?
Yeah, you know, every CEO and CFO that I'm talking to is leaning into what Gen AI can do for their business. You know, IDC is talking about $11 trillion impact from Gen AI over the next 3 years, and businesses spending $500 billion in US dollars on AI by 2027. And so we've been innovating on the platform with our Gen AI SKUs. In fact, we just launched 2 quarters ago, and our Gen AI SKUs are the fastest growing product launch that we've seen in our history. And so it's been in 7 of the top 10 deals this year included Gen AI. We have customers like Microsoft, Novartis, Hitachi Energy really leaning into our Gen AI offerings, and it's just continuing to innovate on the platform and giving our customers more capabilities as they look to strengthen their AI strategies over the coming year.
Gina Mastantuono, I wish we had more time. We look forward, hopefully, to continuing this conversation at a future date. Gina Mastantuono, CFO of ServiceNow. Thanks. Coming up, more on this morning's GDP report with the former chair of the Council of Economic Advisors, Jason Furman. He will join us right after the break. Stay tuned. Stocks are in the red this morning after the latest GDP print showed a sharp slowdown in economic growth and also pointed to persistent inflation. Dashing investor hopes that rate cuts could be coming anytime soon. Inflation worries also sending the yields on the 10-year Treasury above 4.7%, the highest level that we had seen since the start of the year. For more on this, we want to bring in Jason Furman, the former chair of the Council of Economic Advisors under President Obama. Jason, it's great to have you here on Yahoo Finance. Thanks so much for taking the time to join us. Let's talk about that print that we got out this morning, because I think when a lot of people are taking a look at that GDP report, they're taking a look at that headline number, asking themselves a little bit worried about the fact that maybe we are looking at an economy that's considerably weaker than we initially thought. Is that the right take? Or if you look underneath the surface, is there reason, though, to believe that this print actually isn't as bad as that headline number suggests?
Yeah, I think there was very little to be worried about in terms of real GDP and real growth in this print. There was a lot to be worried about in terms of inflation. On the first, most of that miss was volatile stuff. You had inventories subtracting almost half a point from growth. You had net exports subtracting even more from growth. Those are not factors I would expect to persist going forward. If you look at something more like core real GDP growth, consumption and fixed investment, that was up 3.1% annual rate in the first quarter. That's really quite healthy real GDP growth.
Jason, let's talk about maybe the worrisome side of this when it comes to inflation, the pricing pressure, and sticky inflation prices that we are seeing. What do you think this signals just in terms of how much more work the Fed maybe still needs to do before we can even talk about lowering rates?
Yeah, the big surprise here was that at an annual rate in the first quarter, core PCE inflation, which is basically what the Fed is looking at, was a 3.7% annual rate. As recently as 2 months ago, that was expected to be 2.1. Forecasters thought mission accomplished. Instead, we now have a red flashing warning sign. The Fed will not be able to be reassured enough about inflation to cut rates anytime this year, maybe in December, probably not. The only thing that's going to get us Fed rate cuts anytime soon is a much more rapid deterioration in the job market than I expect to get or hope to get, but that's the contingency under which the Fed cuts rates before December.
So, Jason, what do you think, looking out beyond December into 2025, what that rate cut picture potentially looks like then for the Fed?
Look, I think we're in a world where the neutral interest rate is almost certainly higher than what we thought a couple of years ago, but we have no clue, no idea how much higher it is. My guess is the Fed is probably, absent a recession, not able to lower rates much below 4.5, that there aren't that many cuts there absent a recession. But, look over a long enough time horizon and eventually a recession, the cumulative probability of a recession becomes near certainty. So at some point they're going to respond, but I do think that's not going to be because they're reassured about a soft landing. That's going to be because they're worried about a recession. And right now, there's nothing in today's data to increase your recession worries very much, if at all.
And Jason, when you take a look at a number like we got today, or taking a look at the recent trend that we've seen in inflation, the fact that we haven't seen improvement, we've actually been trending to the upside. There has been a bit more talk in recent weeks about maybe the Fed could actually end up hiking one more time. Is it at all in play? Is that at all under consideration for you?
I hope it is for the Fed. It should be. Right now, financial conditions have tightened all on their own. So we've had the equivalent, basically, of one Fed rate hike over the last month, maybe 1.5 after today's data. So the market does that on its own. I think if inflation is, persisting into the second quarter at a rate above 3%, absolutely they should be very seriously considering more hikes.
Jason Furman, always great to talk to you. We hope to have you back here on Yahoo Finance again soon. Former chair of the Council of Economic Advisors under President Obama. Thanks so much.
Thanks for having me.
Checking the movement in the bond market today. We've been talking about it all morning. Treasury yields are on the rise. You're taking a look at the 5, the 10, and the 30-year yields on your screen right there. The 10-year yield right around 4.71%, a move to the upside of just around 6 basis points. So that move coming and hitting at the highest level that we have seen in just about 5 months after that GDP print showed that first quarter, showing that weaker growth and also sticky inflation, clearly a worrisome sign here for investors. Let's talk about that reaction with Althea Spinozzi, as Saxo Bank head of fixed income strategy. Althea, it's great to have you here. So first, is your reaction to the jump that we're seeing in yields today?
Well, Shona, it's pretty simple. The bond market is sending the same message that has been sending in the past couple of weeks, which is if inflation is not going to drop sustainably towards the Federal Reserve target of 2% in inflation, there is no way that we are going to see a bond bull rally. You see, Shona, when we look at bonds, inflation is their main driver. If inflation remains sticky, or there is the risk that it might rebound because of several factors, including escalation of tensions in the Middle East, that's bearish for bonds. So when we look at the 10 years at 4.7% right now, what is telling us is that investors are expecting real growth to remain at trend around 2% and inflation to remain sticky well above the 2% Federal Reserve inflation target.
Althea, do you think we could see the 10-year yield hit 5%? Do you think it's going to continue to trend to that upside given what you were just saying?
Absolutely. 5% is now a very high probability. There is also a very high probability that yields continue to rise towards 5.25%. However, to see a break above that level, we need to have a second wave of inflation. We need the Federal Reserve to talk about hikes again. And right now, that's a little bit of a tail scenario.
Althea, when it comes to investment opportunity or what investors should do at this juncture right now when it comes to the bond market, what are you advising clients to look at?
Well, Shona, I think that this is the moment to remain cautious, to try to limit credit risk and also duration risk. So we really like the front part of the yield curve. There is almost no way to lose money in the 2 years tenors. You see, if we assume a holding period of 1 year and yields rise from 5% to 11%, you will be still in the green. Yields need to rise well above 11% to lose money on that position. It's very different when we look at the longer part of the yield curve, especially the longer part of the yield curve, which is very dependent on bets on interest rate cuts. So it's a very much more directional kind of bet.
Althea, how closely are you tracking the geopolitical risk developments? Because at least when you take a look at the reaction that we see play out across the equity market, across the bond market, it almost seems like that worry is on the back burner for now. How big of a challenge or risk do you see the rise in geopolitical escalation here presenting potentially here for the bond market?
I think it's huge, Shona, because what we have learned since tensions escalated in the Middle East is that commodity prices remain very sensitive to what happens in terms of geopolitical equilibriums. We saw oil resuming its rise. We saw metals prices going up, and that is bullish for inflation. And it might cement a second wave of inflation, which is bearish for bonds. And that's why our message is to remain cautious. If you look at the bond market, remain in the front part of the yield curve up to 5 years. But maybe the 10 years can still offer some value in case of an edge against of a market crash because it offers a good risk-reward ratio. But beyond that tenor, it's important to remain cautious.
All right, Althea Spinozzi, we appreciate your insight today. Saxo Bank as head of fixed income strategy. Thanks so much for joining us here, Althea.
Thank you very much.
Do a quick final check of the markets, at least for right now. We're taking a look at the markets under pressure here across the board, 90 minutes into the trading day. You've got the Dow off nearly 700 points. The NASDAQ now back off nearly 2%. You've also got the S&P back below that 5,000 level. Coming up next, our brand new show, Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour, where he will be digging into whether the latest GDP print, what it means for you and what you should do about when it comes to your investments. He's got that for you. Stay tuned.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's newest guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. On today's show, we're heading into a busy travel season. How much debt are you willing to take on for a fun experience? And helping your team become financially savvy will bring you 3 money lessons that all young adults should learn before heading off to college. Plus, we'll talk big toy maker earnings and the competitive retail landscape. All that and much more on today's show. But first, we got to take a look at some of this market action that's transpiring 90 minutes into the trading day. Take a look at the red across the board here. After a fresh GDP print showed the U.S. economy grew at a slower pace than expected in the first quarter, the Dow, the S&P 500, and the NASDAQ all down. We're looking at an annual growth of 1.6% versus 2.5%. That was the expectation. Stocks reflecting that soft reading. The Dow off 600 plus points, S&P 500 off right now by about 1.3%, and the NASDAQ also slipping by 1.7%. So that lackluster GDP number fueling further losses in tech today, as the NASDAQ is really bearing the brunt of that on at least a percentage basis, jousting right now with the Dow for the biggest loser. And Meta shares plummeting on light revenue guidance. CEO Mark Zuckerberg spooking investors after revealing Meta will spend more aggressively on investments in generative artificial intelligence. You know it is Gen AI in your hood. Plus, let's talk a little IBM. Big Blue. IBM shares plunging this morning after the company missed Q1 revenue expectations and posted weak consulting sales. That disappointing investors, those investors sending shares lower by 9%. Well, we've got much more to discuss. Let's dive a little bit further into the market action today. With that Dow off 600 plus points, heading for its biggest drop of the year, a soft GDP print, fueling the sell-off across all 3 major averages. Here with more on this, we're going to an expert and what this means for your portfolio. We've got Ben Laidler, who is the eToro Global Market Strategist here. I mean, Ben, we wake up, we get a fresh GDP print that disappoints. You get earnings that came out yesterday after the bell, and so you know you've got to put on at least some safety goggles here as you go into today's trading activity here. Give us perhaps some fresh perspective on what we're seeing transpire.
Or you could just roll over and go back to sleep. I do think we all need to just take a deep breath here. Markets were overdue a correction. You know, we've had this low volatility, 20% plus rally since October. We've forgotten what a pullback looks like. But hey, we get 3 of them a year. Your average S&P 500 intra-year drawdown is 14%. So I think we've just got to keep that at the back of our minds. Firstly, and secondly, this GDP number is not great, but it's not as bad as it looks. You know, the bits that we care about, business investment and the consumer are absolutely fine. This weakness was all about the things that we don't really care about and will probably bounce back next quarter, which is trade and which is inventories. Yes, I'm a little bit spooked by the inflation number, but just hold that for 24 hours because tomorrow we're going to get the monthly PCE number, which will give us a lot more information as to how much we should really worry about this today. And markets have already begun to sort of push back on these rate cuts expectations. And then just finally, on the earnings side, yes, tough crowd out there when a company the size of Meta reports nearly 30% revenues and the stock comes off. But overall, earnings season's been fine. 80% of companies are beaten. All sectors have beaten. So yeah, this piles a little bit of pressure on Google and Microsoft, tonight. But I still think the glass is half full here, not half empty.
I'm going to come back to earnings in a hot second, but just to follow up on what you were mentioning with GDP, we typically hear this phrase tossed around, bad news is good news, especially when we're within the environment that we are for the Fed and trying to figure out when that first rate cut will come. Why isn't bad news like we've seen with this GDP print actually good news for the markets, given what the typical reaction would be?
So the typical reaction presupposes that weak growth is going to be good for markets because it's also going to mean weak inflation and interest rate cuts. The problem this time is the combination that this is the worst case scenario, if you believe the numbers, and I'm not sure I do, but this is the worst case scenario of lower growth, lower earnings, but higher inflation, and therefore I'm not going to get the rate cuts. And that's a combination, that's the nightmare combination for investors, right? It means that earnings are coming down and valuations are coming down. So that's how I lose a lot of money. That's what you're seeing a little bit today. I'm not sure I believe it.
Ben, just lastly, while we have you here on the earnings season, and you teed this up perfectly, as we think about what this pertains for some of the other major companies that are set to report either after the bell, we're going to hear from two of those Mag 7 companies, or even later on into the earnings season. What is the tenor that Meta Platforms, IBM even, may have struck with their earnings that's put the rest of the street and investors here on notice as they're kind of doing calculus with their own portfolios?
So the earnings are great. We've had 80% beats. Meta's earnings were fantastic. The problem is not the earnings. The problem is the guidance. And the fact that investors are so sensitive to this tells us that they're nervous and tells us that, we've got the sort of macro tea leaves sort of changing a little bit here. So that moved my first point. And, that helped Tesla. Earlier in the week, Tesla earnings were terrible, but the guidance was better. Meta earnings were great. The guidance wasn't so good. So, it's sort of shifting around, a little bit. We were expecting a lot from Mag 7 earnings. I mean, remember, the backdrop here is Mag 7 is 30% of the index, so it's a really big deal, and they're growing earnings 40-odd%, and the other S&P 493 are basically flat. So, we're expecting that to rebalance over time, everyone else to catch up, but the here and now is that we are very dependent on Magnificent Seven delivering on the earnings front.
All right, Ben, you're setting up our next conversation extremely well for us. Ben Laidler, who is the eToro Global Market Strategist. Thanks so much for taking the time, kicking off the show with us.
Thank you.
Good to see you. Turning to tech here and continuing the conversation on Meta. It's going all in on artificial intelligence, at least based on some of the expenditures that the company announced. Spending billions of dollars more this year on what was already some significant spending on generative AI. And it's more than investors were anticipating here. So what does this mean for Meta's platform users? Here to break down Meta's latest AI offerings, we've got our very own Tech DH, the designated hitter, the man, Dan Halley. Dan, what do we know?
Yeah, Brad, there's a few things here to look at. And obviously, Mark Zuckerberg originally trying to get out in front of the story, basically, and assuage concerns about investments. He obviously said that they've done this before with Reels and Stories, and when they went to the mobile web, kind of trying to get ahead of the narrative that they're spending too much. But what are they spending on exactly? Well, for the average user, there's the Meta AI. That's the AI bot that you'll see at the top of Facebook, Instagram, WhatsApp, Messenger, and on the website meta.ai that you can interact with. Essentially, it's a powerful chat bot using Meta's Llama 3 large language model. And then there's on the advertiser side, there's what's called Advantage Plus. And this is one of the areas where you're seeing Meta actually kind of service a consumer need or customer need with AI. Basically, what you're able to do with this is if you're setting up an advertising campaign, you can more or less automate that process either to a small degree or nearly entirely using this service. And so that makes it easier for advertisers to go ahead and set up their whole plan using Meta. Is a way that the company is actually showing that AI is useful. Now, there's all this talk about how generative AI is going to do this, that, and the other thing. I mean, depending on who you talk to, it's going to be the best thing since sliced bread. Or, I mean, I think one executive, maybe it was at Google or Microsoft, had said it'll be better than the internet or fire. That's pretty wild. I can't, grill hot dogs with generative AI, but maybe at some point. But a lot of what we've seen has been a lot of just predicting, right? Not enough showing. And so this is a company that's really showing, look, we have this generative AI, we're using it, customers are using it, and it gives them a benefit that they're going to want to go forward with. So this, I think, is something that's being overlooked a little bit, something that proves that Meta is making this actually, these investments pay off to a degree. Obviously, the huge amount of money that they're going to be continuing to pour in, not just this year, but as the CFO, Susan Lee, said, in the years ahead, it's still got investors spooked, but they are making this work.
Yeah, I mean, look, Dan, he gave the grilling example. Generative AI should be taking the U out of you grilling your hot dogs at the end of the day. If it's infused into your Traeger or your Weber grill, I don't know which brand is your preference, but we will leave that up to charcoal. There you go. We will leave that up to the companies to determine how they infuse that into our broader summer delicacies. Thanks so much, Dan. Appreciate it. All your markets action straight ahead, plus more here on Wealth on Yahoo Finance. Stay tuned. Let's do a quick check of the markets, sponsored by Tasty Trade. The Dow right now moving lower by about 1.6%, as is the S&P 500 down by about 1.25%, and about the same as the Dow on a percentage basis is the NASDAQ. That's moving lower here on the day by about 1.6%. The NASDAQ was already being dragged lower by earnings from Meta Platforms, but all major averages certainly reacting to a softer than expected GDP print here. Well, gross domestic product, also called GDP in your neck of the woods, is out today. For the first quarter, the U.S. economy grew at a rate of 1.6%, falling short of the 2.5% that the street and economists expected. But let's break down what in the world GDP is in the first place. GDP is the total monetary value of all final goods and services produced in a country in a specific period of time. And this number essentially is a way to look at the health of a country's economy and growth rate. So how's it measured? Well, here's the equation. You've heard of Cigna before, right? Well, for GDP, just think Cignex. GDP equals consumption plus investment plus government spending plus net exports. C, consumption. That's how much individuals are spending on goods and services. This is the biggest component of GDP in the US. Then there's I, the investment. Business investment or capital expenditures, as businesses buying machinery, for example. And then the G, well, that's the government spending. That's how much the government spends on things like military, equipment, infrastructure, et cetera, et cetera. And then we get to the NX, which is net exports, which is exports minus imports. So if a country exports more than it imports, that's a positive contribution. If a country imports more than it exports, then that's a negative to the GDP equation. So let's take a look at US GDP historically. Since the 1950s, there have been notable periods of steady GDP growth and, adversely, periods of contraction. For instance, the 1990s amid the oil shock, the 2000s during the dot-com bubble, and of course a negative shock during 2008 and 2009 with the collapse of the mortgage market. In the last 10 years, we've seen GDP stabilizing, upward trends in 2016, 2017, and 2018, but then screeching halt. Of course, comes the COVID pandemic. The US suffered its worst ever quarter, a decline of 28% in Q2 of 2020. You see that on the far side. So we've seen recovery since. And all that puts today's number into perspective. GDP growth of 1.6% year over year. And then zooming out from the US, the International Monetary Fund, or IMF, recently posted its World Economic Outlook, calling it steady but slow. Their baseline forecast for global economy is 3.2% during 2024 and 2025. That's the same pace as 2023. The IMF also calling for a slight acceleration in GDP growth for advanced economies. That's offset by a modest slowdown in emerging market and developing economies. The forecast for global growth 5 years from now is at 3.1%, the lowest in decades. So all of this being said, the global economy has largely remained resilient despite higher inflation levels, which central banks are globally trying to push back towards healthy long-run levels. Well, we've also got a fresh read out this morning on the housing market. Pending home sales increased 3.4% in March. That's according to the National Association of Realtors. You can see here on your screen that home buyers are looking to buy houses in the Northeast, the South, and West region, as opposed to the Midwest, which recorded losses last month. So, with housing demand reaching its seasonal peak, how can buyers navigate this crazy market and shortage of homes? For more on what this means for the housing market, I'm joined by Glenn Kelman, Redfin CEO, hopping on wealth here. Glenn, great to see you. Thanks so much for joining the show. First and foremost, I track you guys' data all the time. There's a trove of insights that you're able to really extrapolate from where the numbers are moving and where people on the other side that make up those integers are moving as well here. So walk us through what you're seeing in this market right now as we just got a fresh read on housing this morning.
Well, that number reflects March, but I think people aren't as excited about it as we normally would be because interest rates rose since then from about 6.85% to 7.5%, which is a sharp increase. So that means there are fewer buyers, but what we've noticed about those buyers is that they're also more serious. So we think there will be fewer sales than expected in the middle of the year, but it wouldn't be the calamity that it was last year because people have already waited so long to buy a house, they can't put it off another year. So we think buyers are going to hang tough, but it's still a really hard time to buy a house because affordability is under so much pressure.
Well, when you say fewer buyers in the middle of the year, then does that lead you to believe a lot of these buyers are waiting for rate cuts to come through, Glenn?
They are. So affordability right now is really under pressure. Normally, when you have rates increase this much, home prices go down, but actually home prices are up 5%. And if you compound that with what's happened to interest rates, the median mortgage payment is up 13%. So buyers just can't catch a break. In places like Florida and Texas, where it's easier to build houses, prices have been stagnant. But in other parts of the US, we have seen prices continue to zoom up. And so I think buyers are under pressure and there's still not enough inventory. So the best news in the market is that inventory is up about 10%. So I think that will drive some sales, but mostly this market is waiting for a rate cut. And that looks like it's only going to happen later in the year, if at all this year.
What does this all mean for first-time home buyers, Glenn? What should they be anticipating in this market?
Well, they're the ones that are really under pressure. So if you look at the survey data, about 17% of people renting a home believe they'd never buy a house last year, but that number has zoomed up to 40%. So I think first-time home buyers are losing faith in the American dream because more inventory has been slow to come to the market. Rates have been really high. If you are a homeowner who's just trying to move up, you at least have the consolation that your current equity is worth more every year. But if you're just trying to get your foot into the door, that door is being slammed on your big toe because in 2020, 2021, 2022, it was easy to get into the market. You could move from California to the middle of the country and cut your mortgage payment in half. Now, it's gotten really hard because home prices are higher almost across the United States.
So let's give folks some actionable tips here as well, Glenn. When we think about those who are on the sideline waiting for rates to come down or waiting for a prime opportunity to jump in, toss their bids in perhaps, how can they prepare themselves in advance so that they can perhaps outlast the competitive bids or the marketplace as well once others dive headfirst in as well?
Well, I know I'm going to sound like a real estate broker, but that's what I am. And my advice would be to date the rate and marry the house so you can refinance a house later. We have seen multiple offers, bidding wars ease somewhat. So if you're trying to get into a property right now, it's a little easier to do that if you can afford the mortgage payment. And 6 months from now, a year and a half from now, you can refinance that mortgage and still have a house that's cheaper than what you would have paid in 2025 or 2026. So that's my first advice. And then my second piece of advice is just to really be careful about that house. The easiest way to lose money, to just destroy wealth, is to buy the wrong house. If you buy the right house, you're going to be able to own it for 5 or 10 years. There's no way that investment isn't going to pay off. And if you buy the wrong house, no matter what happens to the housing market, you'll regret it because the transaction fees will eat you up when you flip it 18 months from now because you're miserable there.
Glenn, I can't believe that's the first time that I've heard that. Date the rate, marry the house. Glenn Kelman, Redfin CEO, with some actionable tips folks can remember out there. Thanks so much for taking the time. Good to see you.
Good to see you, man. Bye.
See ya. Well, from housing to hospitality, American Airlines, Southwest, and Royal Caribbean also reported earnings this morning, and companies are forecasting strong travel demand in the coming months, despite a more cautious consumer. Inflation and tight budgets don't seem to be too much of a concern for Americans this summer. In fact, a new bank rate report shows that more than 1/3 of Americans are willing to rack up debt just to fund that lucrative and luxurious summer vacation, and well needed. For more on some of the biggest travel trends this summer, we're joined by Ted Rossman, who is the Bankrate Senior Industry Analyst. Ted, good to see you as well. Thanks so much for hopping on. First and foremost, I mean, people willing to take on debt to make sure that they can get some time in the sun or hey, maybe they're going somewhere cold to offset all of the heat, especially if they're in the Southwest U.S. So what are we seeing in terms of some of the trends right now?
We're still seeing really robust demand. It surprises me because 2022 was supposed to be the year of revenge travel, right? And in many respects it was, but the surprise was that 2023 topped it. The TSA actually processed about 16.5% more passengers last year than they did the year before. And then this year, it looks like it's going to be another record. So far, that pace is up about 6% from the same period last year. So I think really throughout the travel industry, we're hearing robust demand, whether it's cruise lines like Royal Caribbean reporting record bookings or airlines are upbeat, hotels. This pent-up demand seems to still have room to run.
And so all of that considered, how can people aptly plan to budget for their summer travel plans?
I think it's really important to set that budget ahead of time. Set money aside from every paycheck. That way you're building a vacation fund. You're not going into credit card debt. Credit cards can be great if you pay in full. That's the thing, because then you avoid interest, you get rewards. Use those rewards points and miles, by the way. That's a good tip to offset costs. And be flexible about your travel schedule. Maybe let the deal dictate when and where you go. That might involve flying midweek instead of on the weekend, or driving instead of flying, or going somewhere during the shoulder season or the off season. I think flexibility really pays.
Who is showing the most propensity to take on debt right now to finance the summer travel plans? I mean, is it baby boomers? Is it the forgotten generation, as they have been called as well? Gen X, Gen Y? I mean, who is it? Gen Z?
It's millennials, actually. Millennials love their experiences, and they're the most likely to be splurging on travel. You know, where it really stood out was a different recent study we did, and we asked not just about travel, but also dining and concerts and sporting events and other live entertainment. That's where people under the age of 40 really stood out. More than half of millennials and more than half of Gen Zers were willing to take on debt this year for those kind of things, versus only 30% of Gen X and 25% of boomers.
You know, it's interesting. I mean, us millennials have lived through so much, so I'm not going to fault any of those millennials out there, those fellow millennials, for taking that vacation, much needed, and a lot of other people too. Just lastly, when you think about the number of businesses that already know what the demand environment is like right now, are we expecting any kind of price moderation in this near term?
One bit of good news is that travel prices have actually fallen a little bit year over year. Rental car prices are down about 9%, airfares are down about 7%, and hotel costs are down about 2%. All of that's according to the latest CPI. So prices have stabilized a bit. They really spiked a couple of years ago, and now they're kind of back where they were pre-COVID. I think that surprises people because costs in other areas have gone up. So I think that's squeezing the budget. But the travel plans themselves may not have quite the same sticker shock they did a year or two ago.
Ted Rossman, who is the Bankrate Senior Industry Analyst. Ted, thanks so much. Appreciate it.
No problem. Thank you.
Absolutely. Coming up, everyone, workers are pretty confident about retirement. We explore how you can be too. That's up next. Let's retire now. That's a statement that everybody wants to make, but ultimately, a lot of people are putting off some of those conversations. Maybe they shouldn't. This week, we spoke to Ali Kawar from the U.S. Labor Department on retirement planning. Here's what he had to say.
For a lot of people, retirement is within reach. Time isn't on your side when you're planning for your retirement. And the earlier you start saving, the better off you'll be. And so one really important initiative is to make sure that things like 401ks are available to as many Americans as possible.
And planning early can help you feel a bit more comfortable with your outlook. 7 out of 10 Americans feel confident they have enough money to live comfortably throughout retirement, according to an Employee Benefit Research Institute survey that's out today. To break down how to set yourself up for success in your golden years, Robert Powell, Retirement Daily editor and publisher, is here. Great to have you back on the show with us. Okay, how can people, even if they're hearing some of these stats about preparedness, how can they take that first step to ensure that they're at least starting the planning in the correct way?
Yeah, so what's interesting about the EBRI study is, first of all, how confident people are. But what's, to me, even more interesting, Brad, is the notion that there's a high correlation between planning for retirement and being very confident that you'll be able to enjoy the same standard of living in retirement that you did in your working years. And that's really important, that people plan. The other really interesting note is that people who have a financial advisor are also more likely to feel very confident about how their retirement will be. And so I think put those two things together, do the calculations, figure out how much you need to save for retirement. And also, if you need to, hire a financial advisor, or at a minimum, maybe find a financial advisor who will charge an hourly fee and who will be your sounding board, especially if you're working and you're young. Having those two things in place will definitely not only lead to higher confidence, but I also think will actually lead to higher success in retirement.
You know, the Principal Deputy Assistant Secretary for the Employee Benefits Security Administration that we spoke to yesterday, Ali Kawar, I had asked him the question essentially about what the real figure is like, and that's different for everybody, right? Based on how you intend to have a lifestyle in that retirement, whether you plan to have supplemental income or, just how you want to maintain a mentality and whatnot. We got kind of a quasi-answer, but I guess it's a quasi-answer because it's so different for everybody, right? And so where has that kind of average goal moved towards? Where is that goal line now?
Yeah, I'll give you sort of two rules of thumb, Brad. One is to sort of think about how much money you need to accumulate relative to your salary. So companies like Fidelity, T. Rowe Price, Lincoln, others have said maybe what you need is somewhere between 10 to 12 times your final year's salary set aside in your nest egg in order to fund your desired standard of living. The other folks say another rule of thumb would be to look to replace 75 to maybe 80% of your pre-retirement income in retirement as a way to sort of make sure that you'll have the same standard of living. I think those are great places to start, but there's no substitute for actually crunching the numbers. I always think of retirement income planning as a Excel spreadsheet. I think of it as a row by row and column by column exercise. Now, the one thing I'll say about both these numbers is it varies by income. So for folks who are in the highest income quintile, they may not need to replace 80% of their pre-retirement income. They may only need to replace 50%. For folks in the lowest income quintile, on the other hand, they may need to replace 90% of their pre-retirement income. And the bulk of that money, at least in the lowest income quintile, will probably come from Social Security. And for those in the highest income quintile, Social Security will represent a very small portion of their retirement income, maybe 15%. So you're right, it varies, and it varies mostly by income levels, but also education levels and race.
For those who want to enjoy retirement, but also want to stay, active to a certain extent, are there common jobs that you find people gravitating towards, even in retirement, to enjoy, a certain lifestyle or a certain kind of acuity maintenance?
Yeah, I mean, you see lots of folks who are going into retirement. Well, two things I should note. A lot of folks at the moment, according to EBRI, do plan to retire at age 65, but also to keep working after they retire from their full-time jobs. And I would say that's a good plan for some and a bad plan for others. The reason it's a bad plan is, according to EBRI, only half of those people who say they plan to keep working in retirement are able to do so. So if you're planning to work out of need as opposed to out of want, I would say come up with a better plan than that. And then in terms of working in retirement, if you've been a white collar worker in the past, maybe you want to dial back. Maybe you want to become a consultant. Maybe you want to become a contractor to the company that you previously worked for. Maybe you want to do something entirely different and maybe work in your field, but for another entity, maybe for a nonprofit, for instance. And part of this working in retirement is a matter of want and need, or a combination of both. If you need to keep working because you need to fund your living expenses, that's a very different story. If you're working out of want because you need the social interaction, you need somewhere to go in the afternoon aside from, maybe going to the local coffee shop and spending all day there surfing the web. That's a whole nother thing as well. And then for the other people in the middle, it's a mix of both. In some cases, people do need the income. In some cases, it's a combination of need and want.
Robert Powell, Retirement Daily editor and publisher. Great insights as always. Thanks so much, Robert. Appreciate it.
Thank you, Brad.
Certainly. Coming up, everyone, Chipotle reported its latest earnings after the bell on Wednesday. We break down what that means for you and me, too. I bought a couple burritos last quarter. We got you on the other side of this short break. Chipotle posted better than expected results as consumers, like me, continue to think of the burrito chain as a great value proposition. Here with the 3 things consumers need to know following the results is senior reporter Brooke DePalma. Hey, Brooke.
Good morning, Brad. Absolutely. On Wednesday after market close, Chipotle beat the estimates that Wall Street had expected from the company. So let's break it all down. What is keeping consumers coming back for their chicken or their steak, burritos, or their bowls? Well, first thing you need to know is that CEO Brian Nichols said on the call it is seeing gains with all income cohorts, low income, middle income, and high income consumers. He said that every group says Chipotle is a great value proposition. So what exactly does that mean? Well, that means that consumers think that they're getting the best bang for their buck paying for $9 chicken burrito bowls. Now, the second thing you need to know, Chipotle still thinks that it has pricing power here. This means that as GDP grows at a slower rate, and if consumers tend to pull back or become under pressure, well, he says that they still have money for Chipotle. Take a listen to what CFO Jack Hartung said this morning when he spoke to our own Brian Sozzi.
When consumers are under pressure, if we're executing at a high level, customers tend to keep Chipotle in their budget longer than they will keep other dining experiences and other things that they want to do. They will keep the Chipotle in their budget for a longer period of time.
And the third thing that you need to know, if you're heading to California anytime soon and you happen to grab Chipotle while you're there, well, you can expect to pay slightly more. You see, on April 1, the FAST Act went into effect in the Golden State, which raised fast food wages to $20 per an hour. Now, that caused Chipotle to have to raise wages by, get this, nearly 20%. And to offset that cost, it raised menu prices by 6 to 7%. But the chicken burrito bowl there will still only cost you about $10. And Brad, I have to say, I recently went to Chipotle and I did in fact only spend about $12 for a chicken burrito bowl, but it was my birthday month, so I did get some free guac on the side.
Brooke, I'm upset. I've been running the tally on mine, and it's an average of about $15. So clearly, I'm adding something on that is wrong and not getting me to that average.
Are you getting the queso, the guac, double protein?
Look, I might just need to take you and Sozzi with me next time to see how you guys hack the Chipotle costs here. But ultimately, I'll give it a shot on my own, and then we'll ultimately bring you back and see what happens. But Brooke, thanks so much for breaking this down for us. Appreciate it. I'm frustrated now. Whatever, let's end the show. We can't do that. We gotta talk about this. Most adults expect teens to worry about their clothes, shoes, dating, maybe even their Chipotle orders, but they probably don't expect them to be worried about money. According to Wells Fargo's money study, 83% of teenagers actually want to be better with their money. So how can adults help set them up for success? Joining me now, we've got Emily Irwin, Wells Fargo Wealth and Investment Management Managing Director of Advice and Planning. Great to have you here on set with us, Emily.
Great to be here, Brad.
So let's dive into some of these results here. More teens, they want to be smart about their spending, about their saving. What did the survey really show and tell about how they're setting themselves up for success?
Yeah, well, you've already mentioned 80% of them are really focused on wanting to manage their money better, and that is an incredible statistic. What's interesting is it's in direct conflict with the fact that most adults shy aggressively away from wanting to talk about money. And so we have to, as adults and as parents, really set that standard for them to be able to have these conversations.
And so with that in mind, I mean, what's the kickoff point for some of these conversations? I mean, it can be awkward, it can be dicey when you're saying, hey, sit down, Junior, I want to tell you about how you can really make sure that you're managing your money right.
Yeah, let's bring the abstract and the concrete together for kids. That's really important. And so we can start small, whether it's things like showing some of the finances that you might go through on a regular basis. So I think one of the great ways to do this is by instituting both one-time expenses and recurrent expenses with teenagers and kids. So for example, it might be easy to be able to set standards for how do we save for a bike or a new laptop, but we also have to complement that with what the reality is. We like to save for vacations. We also know we need to save for rents and utilities. We also need to make sure that our kids are able to save for cell phone plans or maybe streaming services. How do you balance the two? And you can help them start that by being able to help them set a budget, for example.
And so teens right now, does it seem like, especially with Finstagram, FinTalk, that they're more excited to talk about money and financial planning?
They absolutely are. They're out there. They're talking about, how do we save money? How do we budget? How do we make the most of our dollars? And they want to understand even concepts that might be complex, such as what is compounding? How do we make money on our money? And so as parents, one of the fabulous things is to really set them up for success is to be able to sit them down and say, okay, you have $1,000 from your summer job, for example. If you have an interest rate of 6%, you're going to have, after 1 year, $1,060. Great news. You do that in year 2, you're going to earn $63.60. So all of a sudden, you're earning interest not just on your original amount, but you're earning interest on your earnings as well. That can exponentially grow. Introducing kids at a young age to that concept of money growing on top of money is really important.
Compounding is part of the 3 tips that we want to give people as well here. You've got 3 actionable tips for kids who are, or just young adults that are ready to go to college and planning for that as well. What are they?
Well, savings and compounding, super important. We definitely want to make sure we touch upon that. Understanding credit. This is where I think kids, for the first time, you turn 18, you might be on a college campus and you're approached about opening up your first credit card. Don't have that be your first introduction to credit. Let's talk about credit and starting it early. Explain what credit is really made out of and why it's important. It's going to help you borrow money. Lenders are going to want to let you loan money to you too. You're going to be able to do it at a more advantageous rate most likely and on better terms potentially. They look at credit history, credit the amount of credit to what you have outstanding, and then of course your on-time payments. That is critical. Maybe even consider having your teen as an authorized user on your card so they can start building credit. And then finally, budgeting. At Wells Fargo, we have a LifeSync in the mobile app experience where you can upload pictures, get inspiration. That is a fabulous way to start thinking about managing both your everyday expenses, checking in with them intentionally, but also understanding how are you going to be able to fund those longer term goals like spring break maybe?
Oh, yeah, indeed. A big funding topic there. Emily Irwin, who is the Wells Fargo Wealth and Investment Managing Director of Advice and Planning. Thanks so much for taking the time here with us today.
My pleasure.
Absolutely. Well, if you're still struggling to make a decision on which college you'll be attending in the fall, you better make it quick. The deadline for accepted students to decide their next step is traditionally May 1st, but there's a lot of financial factors to consider when making this huge decision. Yahoo Finance's Rochelle Akufo joins us with more. Hey, Rochelle.
Hey, Brad. So I want to focus on three key financial factors we should focus on: your FAFSA and deadlines, your resources, and your return on investment. So we'll start with FAFSA because there are lots of ways to pay for college, but the FAFSA, the free application for federal student aid, is one of the most important. So it gives you one centralized place to apply for grants, federal loans, work study, jobs, and more. Now, recently, Scholarly by Sally founder Christopher Gray joined us on Yahoo Finance and talked about the biggest mistake prospective students make. Take a listen.
I think that just being able to start as early as you can. And if you do have to wait the last minute, that's fine. People have different responsibilities, but that is the biggest mistake. Waiting to the last minute and just having to rush and do all those essays and applications. You have to submit FAFSA forms. You have to do all those things.
Now, of course, that FAFSA deadline is June 30th, but many schools give on a first-come, first-served basis. And of course, it varies by financial need. But keep in mind, there are no income limits to qualify. So don't think you or your family make too much. You can still apply. But of course, do check for any variations when it comes to your specific college, as well as any state requirements as well. Next, I want to focus on resources. Now, you still have to formally accept the offer. They have just sent you an offer. You do still have to actually formally accept it, review and accept the financial aid offer as well, plus send the enrollment deposit. A lot of times people might be, celebrating, saying, buying all the merch. Please make sure you've actually accepted the offer and make sure that you check that specific college's requirements before you post that video. Now, if you're a little bit nervous because you were waitlisted or deferred, follow up immediately with a compelling letter of continued interest with any sort of added accolades since your original application. And don't forget to keep applying for funding for your next best college choices. Now, third, return on investment. Now, of course, we've got to talk about tuition. Now, the College Board expects the average tuition for the incoming 2024 freshmen to range from just under $14,000 for a national public two-year college to over $55,000 for a private four-year college. Obviously, a lot of range within this, so make sure that you're picking a college that makes sense for your pockets.
Yeah, and I was still at the top end of that range almost 12 years ago. Rochelle, that's my own bad financial decision. It paid off a little bit. But anyway, costs go beyond tuition, though, here as well. Break that down for us in that factor.
And that's true. That's something that people tend to forget. One of the things, obviously, we've been talking a lot about housing. You have to factor in your student housing beyond your tuition, your transportation costs if you're going to be living off campus, depending on your major, your technology and lab cost requirements as well. And then you really have to balance that with the value of the education that you're going to get. Is this the right place for you? Think about the alumni connections, what that opens up for you, some of these soft skills that may not make sense on paper, but when you're out there in the world trying to get a job, do make sense. Also, the job acceptance rates for graduates, some of the salaries also, not just for your major, but from that school once you graduate. So really take a holistic view when you're investing in your education here.
All right, thanks so much, Rochelle. Really breaking that down for us. A lot for families to think about ahead of decision day. Thanks. Exactly. Clock is ticking. Everyone, we've got much more on wealth after this short break. You're watching Yahoo Finance. Toy giants Mattel and Hasbro both out with first quarter results, and both companies reporting sales declines in the first quarter. Mattel reporting a sales drop of 1% from the year prior. Hasbro saw a whopping 24% revenue decline from the year before. There are a few positives, though. Some of the results were a bit better than feared. And we're seeing improvement in inventories, but there's no doubt the industry is facing challenges from inflation to increased competition from e-commerce giants. Here with more, we've got James Zahn, editor-in-chief at The Toy Book and senior editor at The Toy Insider. Great to have you here on the show with us, James. What happened in this quarter? What's the biggest trends that's rocking these companies right now, these toy manufacturers?
Well, the toy industry is in a weird spot right now because we're coming off of a couple years with the pandemic. We had all those sales booms that no one planned for, and then they started to dive down. That softness at the end of 2022 rolled into 23, and now we're seeing it again coming out of the first quarter of 24. The big things right now are that families are dealing with economic concerns. They're paying more for groceries, more for gas. The excitement at retail really isn't there because all the newness hasn't come in yet. So we're still in kind of a wait and see until some of these new exciting products start hitting towards the middle of the year.
I'm reading through some of the notes here on the overall industry, and my God, Furby came up yet again here. Walk us through this, because this was a $60 Furby last year. I mean, look, that even takes me by surprise that it's priced at that level when people used to look at Furby as alt investments. So now we've got the $10 Furblettes.
Yeah, so I remember when the first Furby came out from Tiger Electronics in the late 90s, and it was about $40. The new Furby was introduced last year, did very well as a $60, $70 toy, but again, that prices some folks out. So now we're becoming really price conscious, and we're seeing the industry start to look at those prices again at the fives. $5, $10, $15. Well, Hasbro came around and they have Furblets now, which are a $10 Furby that's about half the size of the regular one, but that makes it accessible to a whole bunch more families out there.
You know, I was speaking during the break with the Yahoo Finance chief toy correspondent Stowe of Shauna Smith fame, and he was telling me about trucks and how that's his favorite toy. I see an Optimus Prime behind you. I know that that turns into a truck as well, and that really comes back to toys that are really tied into the movie-going experience and the content experience. Where do you see that to still have legs, perhaps in these next few years, coming off of a year where we already saw how well Barbie did?
So we have a couple things to unpack here. First of all, it is a big milestone year for Transformers. Hasbro's key brand there. It's the 40th anniversary, and they're going to sort of reboot things later this year with this CGI animated film called Transformers 1. It's a new telling of the lore that ideally will captivate a new generation of kids that are going to be into Transformers for the next 40 years. That's very important. And when we think of content, the content really has to connect with kids. Now, Barbie last year, obviously huge smash, one of the biggest movies ever. But the toys that came out tied to that movie, a lot of them were grown-up skewing, like collector dolls and stuff. So Barbie didn't move the needle in the toy department quite as much as some folks might have thought. However, back half of this year, we have Barbie's 65th anniversary. So we're going to start seeing more toys geared towards the cross-generational audience. The key here is, can Mattel get another movie in front of cameras to keep that momentum going? And if I were to bet, I'd say Hot Wheels is the next obvious choice. They've got about 15 films in development, but the vehicles category for Mattel is just a behemoth. Hot Wheels is in his sixth year of growth.
Wow. James, a lot of our producers seeing in the background that you've clearly got that Barbie Ken doll back there of the latest edition, the Ryan Gosling edition here coming off of the movie. There we go. All right.
Is he Knuff?
Is he Knuff? This Ken's job is surfing. All right. Thanks so much, James. Appreciate it.
You're quite welcome.
Absolutely. That's James Zahn, editor-in-chief at the Toy Book, and we will continue to track exactly where people are dancing the night away here. Editor-in-chief at the Toy Book, James Zahn, joining us here. Everyone, that's it for now. I'm Brad Smith. Thanks so much for watching Wealth. We've got much more. 11 a.m. tomorrow.